All right, everybody. Welcome back to the Cashflow Chronicles. It's another beautiful Tuesday. The market continues to run, as you will see on the ticker symbol at the bottom. Nvidia is just below 500. Dutch Bros pulled back a little bit today. Apple is still hitting that $200 resistance. The S&P 500 at 475 and continues to go on a massive jog. Q's at all-time highs. Palantir still at 18 bones, so just below 40 billion market cap. Google hanging out at 136. Amazon blew through 150 over the past week. Bitcoin still hanging out at 42. Oil up a little bit from the high 90s as it was. And Henry Hub back above the low $2 range, back to $2.50. Chris, I didn't catch all of Finance Junkies. I know you guys talked a little bit about oil. You talked about how Enphase is going to the moon again. Residential solar is going to outpace utilities. I don't agree with that piece, but
no, the other way. I said it the other way. I said
I know you did, but the other folks were kind of saying that I'm more with you, right? Utilities, I think, but so there's that piece. But anything else that you wanted to bring up that you weren't able to bring up in Finance Junkies? I don't want to just rehash what you guys talked about over there.
Yeah, I think there's a bit of optimism that's in the market right now that could be done away with rather quickly. So it's a good idea to apply some caution right now, and just keep to the higher quality names. Don't get caught up in this chase because you see that other people are in these more speculative names and their portfolios are riding high. You think, hey man, I missed the boat. I need to get on it too. And it's just like, no, just be careful, be cautious. The companies that we invest in tend to have a lot more staying power and a lot more potential for recovery long term. Mm-hmm. And there are times where we can take short-term moves, like the play on Oxy and ExxonMobil. This is a short-term move for us. It's nothing that I believe that ExxonMobil and Occidental are the future, but oil prices were really bottoming to the point where it was likely to affect U.S. producers, because at the end of the day that you need to break even on a project in order to make money. So at $70, there are a lot of places that are uneconomical. So we just have to keep that in mind, so let's pull up our model portfolio. Let's see what we're doing with it.
Yeah, lots to go back onto that while I'm pulling that up in the background. I mean, Chris kind of hit it on the head. Like I still thought that there was probably room to pull down in terms of oil prices, but as Chris alluded to, I think that there's more upside than there is downside at this point. A lot of people are starting to pull back in terms of their growth plans. They're being more prudent with their capital. You have folks that need to run their countries, not just their companies, but their countries off of this oil price. And so when it gets to, the $70 a barrel range, that's kind of the same place that people were back in the 2020, 2019, 2018 timeframe, where it was kind of the balance point for the companies. And let me just knock out some of these account numbers here, and we should be good to roll. And so with that, I think a lot of people don't recognize that, it's not just about the energy or the project prices that you observe on like Guyana or a West Texas or something like that. It also has to do with, can the Middle East from some of these welfare states run their balance sheets on the country? And I think that that's more important. So Saudi Aramco can pull things off, out of the ground for, a couple bucks, right? It's not going to be something that they're going to be hard to do. They're not going to be losing money by pulling stuff out of the ground. Where they're going to be stuck is the fact that they're going to be stuck is have to pull a bunch of and fund a bunch of other things associated with it, the healthcare, the education systems, the dental, all that stuff for all the citizens, right? And that's part of the reason why they're trying to diversify, right? You see the Saudi the Saudi investment fund, the public investment fund, starting to look into like live golf and sports and all these other things to try to diversify because of this ups and downs and the volatility that you have in the oil markets. But regardless, the portfolio's up, still below all-time highs for us, which I think we were at 1070 or so for our all-time highs, but we're right up there. Let's see what went up and did well today. HCP, Rocket Lab did okay today. Accelera is on a run. It's up 35%. TQQQ is still the best performer. Orsted is still the third performer. So yeah, up overall. Tal Z is our thorn in our side. You're on mute, my guy.
But that's our, spec play
Yeah.
that could double on us. It's only down what, $24. The rest are there. So what is it? Down 16%. It's not bad.
Yeah, it's not. And I think I'm trying to remember what our dividend is on that. I think it's close to 13%. So like 3% a month. Sorry, 3% a quarter is what we should be getting on that.
No. It's more than that for Tel Z. Yeah, it's more than that. Remember, it's 8.25, and we got 25. Yeah, so it's something like that. We'll see what happens. My hope for Tel Z is, of course, going to be like an acquisition target, because I don't think they're going to survive another 6 to 9 months. They're going to be acquired, in which case the debt is going to get paid out. So that's the goal, hopefully, for that one.
That's kind of the thought process. Yeah.
Yeah.
But yeah, TQQQ, that's been on a run for me. I've been thinking about personally in my personal portfolio, like, do I take a little bit of profit off the table? Because when you look at things, and I've been trying to do a little bit more back and forth from a not like a full-time trading perspective, but just like a little bit. I was telling you about like my long SPY calls that I was buying. And I'm not talking leaps or anything like that, but just the monthly boys. And I'm trying to figure out a way that when you recognize that the RSI on a daily or weekly basis is really starting to bottom out, it obviously gets to a point where you start to turn the corner, right? And it can still go down, right? But generally when the RSI, Relative Strength Index, goes down to 30, and people generally classify this as like the extreme greed or like fear gauge almost, where it's like once the RSI gets down that low, it pretty much coincides directly with that. You're a month or two away from kind of turning the corner, and most of the time continuing to go up. There can be extended times where you continue to go down in terms of the relative strength index, or it just stays flat. But generally speaking, it's one of those times where you hit it, you come settle for a week or two, and then you bounce off of it and go more towards the middle of the range. And if you're able to kind of time those things, and it's not a guaranteed indicator, right? But it is an indicator. Will you be able to, in the long term, kind of do a little bit of work and be cautious and kind of work with the ebbs and flows of the market? Because that's the way I really view it, is like, to me, that's just money flow, right? And I think so many people have cash automatically set up through their 401k, direct investments. So like, for example, I have 7% of my monthly paycheck automatically goes into the S&P 500. And I know plenty of people that also, and there's also the people that don't, right? I get that. But I would say on a monthly basis, you have consistent money being paid from employers directly into the S&P by a couple percentage points. So it's like you're always, I feel like over time, over a 5-10 year period, you're always going to have influx of money into the SPY. So for me, yes, there's going to be the short-term pullbacks, which I think we are due for one. I think that that's not anything that's going to be surprising to people. When I say pullback, I mean 5 to 10%. I don't think there's going to be anything too crazy, but I'm a believer that this thing's going north of, meaning the SPY, the S&P 500 as an index, is going north of 5,000 next year. I'm just kind of curious if it happens early in the year and we flatline, or if it's going to be this slow and steady, couple percentage points a quarter, get your 10% or so, or maybe it's even 5% or so over the next. But generally speaking, and then I'll hand it back to you. When you look at the overall returns, and maybe it's something I could pull up in the background, you don't generally see returns in the 5 to 10% range. You generally speaking will see returns that are flat, returns that are closer to 15 to 20%, some outliers in the 30+%. And you also see some that are mostly in the, not mostly, but on the negative side, 0 to 10%. But then there's outliers of negative 20+%. But the majority of the time, like when the market goes up, it goes up. And it normally goes up more than 20% per annum. It's just then you have the pullbacks and the flat years that drag that down to be where it's hanging out at that 8-9% range that people always talk about, right? And so
Yeah.
that's kind of the fun part about it, is just like when you see an opportunity where the market is generally already down, it's probably a time to put your money to work. And I'm one of those people. This is how I invest. I just always have my money mostly invested, but I do
Mhm.
see an opportunity here where people can slowly start to trim off a little bit off the top, and maybe garner some cash and look for opportunistic things, because I think the indices might be running hot, but there's still going to be individual stocks. It's actually what I talked about with Crossroads, Roy, a good bit today. We were like, there's so many individual stocks that I think are
Mhm.
outsized, or sorry, underweight right here. And I think a
Mhm.
lot of money will be running into this.
Yeah. No, I agree. I agree. I'm in the same boat as you are right now. I think it's worth just being a little bit more selective. Like last year was a little bit less in terms of making money on the selective side. Um, this guy, he does a really good breakdown. Let me just share my screen real quick. Um, right here. Can you see that screen right there?
Yep, can see it fine.
Okay. So you can see here, these are the annual returns for each of the different classes that are out
Are
there.
these
So
like
Bitcoin,
specific indices, or is it?
no, no, well, yeah, it's specific indices. So, like at the top, you have Bitcoin. So you can see here, Bitcoin had 1,000% rally, a 200% rally, a 5,000% rally in the early part of it, and then I had a huge drawdown, about 50%,
How
and then I
could
had
you?
and then it's had rallies, and then it drew down 73%. Now the thing is, when you look at these drawdowns are pretty significant, and to recover for that drawdown, you need to ride much higher in
Mhm.
order to get back to where you started. So like right here in 2022, Bitcoin was down 65%, which means that right now, even though Bitcoin is up 151%, it's not even back to its 2022 level, you know? So
Mhm.
that's like one of those things you just have to keep in mind. So avoiding these landmine years is actually one of the secrets to making sure that you grow, and you grow very well, you know.
But the problem is, Chris, like with that, and I just want to interject, is like a lot of times you'll have people that are like, "Ooh, I think it's going to be a landmine year," like you said, and then they wait all the way through. Let's take 2018 for example. They're like,
Mhm.
"Ooh, I don't know. It's already down 73%. It's going to go down 80%. It's going to go down 85%." And then they never get back in. Right.
Right.
I know so many people, and then I'll hand it back to you because I appreciate I cut you off. But like so many
Yeah.
people that I know that were like, "Ooh, Google's going to continue to go down, go down, go down," and they sold it at like $95, and then they never bought it back at $80, or they never bought it
Mhm.
back at 85 or $90. And now that it's when there was back up to 120, they're like, "Do you think I should get back in?" I'm like, "You never should have sold. Like
Yeah.
you should have kept buying if you had the cash. But here you
Mhm.
are selling at 100. Now you're wondering, now that it's kind of rallied back, to get back at 120. And so you have to, like, if you're going to play this game and be vigilant, like Chris is talking about, you really have to have an eye like a hawk, because most of the
Yeah.
time people will just be like, "Oh, wait." And then it's like, well, if you wait 6 months, sometimes 6 months is 4 months too late.
Yeah. No, I agree. I mean, if you look at the cumulative returns, the best place to be for the last 10 years were the QQQs, right? Where basically it's just high growth tech. And that's why tech, when it took a huge drawdown in 2022, it also had a massive run up in the year following. And you can see that that's actually a normal occurrence since forever. Same thing with US growth. Anytime you have these really terrible years, the year after that tends to be, pretty decent. Commodities, if you look at it, they're like the worst. That's why I'm not a fan of ever dealing with companies that are in the commodities outside maybe just a short-term swing trade, right? So the two areas that I think are going to do exceptionally well next year are REITs. So if you look at VNQ, pick the right and you do the right selections, you can see outperformance in the REIT side, because even though they took a 26% drawdown last year, they're only up about 10% this year. So there's still a long way to go. And you can see that sometimes you get into the secular trend in the REIT side, where you see nice long-tailed long-tailed growth without any correction. So look at what happened in 2011, 12, 13, 14, 15, 16, 17. Every year you just had growth, 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 right? So usually you want to be in industries like that. US large caps is a very similar thing, where post 2008 crash, you just saw growth, 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 growth without much slowdown, right? So I
Yeah.
think we're headed into this period where we're going to see some rotation, maybe out of Nasdaq. Not so much. I think Nasdaq is still going to do well, but maybe it's going to find its way into some of the other parts of this. So as an example, the IWM, which is small caps, and MDY, which is the mid caps, I think they could end up having a nice banner year next year, because if you look at like the recovery, they haven't recovered nearly as much as like the Nasdaq has, you know. So
Yeah.
there could be a rotation into that. Same thing with the REITs. And you know, I'm always impartial to be in high quality tech names that haven't recovered yet. So that's why I'm on the Google train and the Amazon train at the same time. I think there's still a lot more room for them to run. I'm not so optimistic about Apple and Microsoft, only because the valuations on a forward basis are a bit stretched, you know,
Yeah.
whereas Google and Amazon are not nearly there. Even Meta to some degree is not there. So
we
this,
actually looked at that because Junebug was talking specifically about Apple, and she called it a value stock, and I was just like, I don't know about all that, you know, because I looked at the price to earnings and the PE is 32, and so I just did a quick look. It's like obviously Apple's been on a run, right, and you can't say that it hasn't. But the thought is like, is it truly a value stock? Now, of course, they've bought back 40 odd percent of their shares outstanding over the past 10 years. So you got to give them kudos for that, because that alone is going to give you a huge jump in the stock price. And they've obviously grown their earnings by 250 odd percent or something like that as well. But the majority of the growth from Apple is actually from the margin expansion. So if you looked in like the 2013 timeframe, when Apple was trading, their PE was like 8.5. And now it's sitting at a PE of 32. So when you think about it in that perspective, their PE or price multiple, just even if earnings stayed the same, has gone up 4x, right? So it's like that's where the majority of the money in Apple has come from. And if you think about it in that perspective, if they were to go back just as a simple price to earnings multiple of 8, 9, because it's, you know, people are going to say, are they growing still? You know, if that decides to flop, you can easily see Apple drop 30, 40% if it wanted to come down to a normal PE of, say, between 15 to 20. But because it's such a premier stock, it's because it's so premium of a stock that people value it so much. It's sitting in the 30s. But when it was out of favor in 2012, 2013, they were like stalling a little bit on their iPhone sales. And right before it went on this massive jog, before it split the first time in recent years, at least in the last decade, you know, it's trading at a PE of like not 8 or 9. And so if you think about it, it's like a lot of times, just like what Chris is saying with respect to Microsoft, that's what I'm staying away from as well if I had the opportunity, because the PE is 38. You could cut the PE in half and still be considered expensive to some people, right? So like that stock could drop 50% from here, and maybe it's going to continue to grow into that valuation. Maybe if you look at how Azure is doing, when you look at a fiscal year 2025 basis, maybe it's trading at a fiscal year 2025 of like the high 20s, which I would say is actually okay. But I don't know. I haven't done the due diligence to say like, okay, on a fiscal year 25 basis, it's trading at an appropriate margin. It is just the trailing 12-month that looks super expensive, right? So I don't know in that respect. But if you look at like a Google's trading, you know, pretty cheap comparatively to those guys.
Pull up these charts real quick, and we'll go over that. This right here is Apple's forward earnings multiple. Okay, so you can see here right now they're trading at the higher end of their multiple range, right? So if you see historically, they've traded between 10 and 20% on a forward basis. They blew through that, and now they're trading at about a 30 times their multiple. And some of it is well deserved. They took a huge drawdown in 22, like everything else in mega cap tech, and they kind of pulled back to the the 20 times forward range. On the other hand, if you look at something like Google, which, let me just pull that up, share screen right here. Can you see the screen? So you can see here in terms of ranges, Google is trading right at the middle range of its middle of its pack, right? It's not above, it's not below, it's right there in the middle. And you can see here that over a period of time, it's stayed relatively between the 20 and the 30 forward PE. And right now they're at the base of their earnings multiple. So if we take into consideration all the share buybacks and the expansion of EPS going forward, Google has a much easier shot at going to $200 than Apple does of getting to 150. Even though Apple only has to go up $50 and Google would have to go up $70. So you see what I mean? Like, from a total risk to reward standpoint, you're taking on more risk by being in Apple for less reward than you are with Google, because Google is right now in more of a value position than Apple is. So I think that's the key to just take some food for thought on a forward basis anyway.
Yeah, absolutely. And I think that there's a lot of other stocks like you're mentioning here that you front run, which was like, Atcore and several other companies that were starting to be relatively cheap comparatively how fast their earnings were growing. I still think that there's that opportunity out there in small caps and many other companies. But I want to highlight something specifically in the chat here where people are saying, they're comparing, and this is the problem where you have to be cautious, because you could be sitting here being like, well, Exxon and Chevron are very well-run companies as well, right? And so when you think about it, you have to acknowledge that when you're looking at a trailing 12-month basis, the oil price was in the 90s and in the 80s. And so when you're looking at a trailing 12-month price to earnings ratio, it might still be, let's just say a PE of 10 or something like that. But when you get to the high 60s, low 70s, that earnings is going to drop pretty drastically for those companies. And you also have to think, like, so where are these companies in their cycle? So, if you think that, Exxon has dropped enough, Chevron has dropped enough, that it's in a value standpoint, and you think that oil is going to go back to $90 to $100, then by all means, right? Pick some up here. But I think that with where oil prices are, you kind of have to be cautious with this one. So you have to find the ones that have true disparity in their price to earnings, which is why I'm saying this is because a lot of people will buy oil stocks when they're at their peak. Like, I saw a lot of people rushing into energy in 2022 when oil stocks were trading at 6, 7, 8 PEs. And it's like, well, why are you buying it at these prices? You realize that the PEs are 6, 7, and 8 and only single digits, because it's more likely that the oil price environment is going to decline from here. And when the oil price declines, earnings will decline. And therefore, the price to earnings multiple will expand back upwards because the earnings will decrease. So, and then you did see that, right? You saw year over year price to earnings decline from Shell, Chevron, Exxon, all these different companies. And I'm not saying they're bad companies, but I saw a lot of people wanting to invest in those companies, not when the oil price was $30, $40, but when the oil price was $130, $140. And it doesn't make sense. So you really have to think, when you're investing in these things, when you're looking at a price to earnings ratio, that's not the be all end all metric that you need to utilize. You need to recognize where some of these companies are in their cycle, right? Do you think that Apple, Microsoft, Google are those companies right now in the beginning of the cycle, or are they tailing off towards a recession, right? because they could be trading at a 30, 40 price to multiple in the middle of their increase of the trend in a bull market. But if you start getting to recessionary times, that 30, 40 PE is not going to be very happy if you enter a recession. And it'll probably get smacked down, as it showed for Google in 2022, which I believe was the recession. It dipped down to way below 20x earnings, and it was hovering above 30. It was like a 30, 35 multiple before that 2022 time period. It got smacked and clobbered and went way below 20 times, and now it has
The thing
climbed
is,
itself back up.
to some degree, it deserved it, because what happened was, if you looked at their earnings multiple in 2021 on a forward basis, it was a bit of a, how do I describe it? It was a bit of a false flag, because what happened was they had done all this additional hiring, which impacted their EPS. So this is the part that I think a lot of people missed with Google. Let me just let me show you something really quickly. Earnings. So if you look at, I'm sorry, give me 1 second, just pull this up. So if you look at Google, this is Google's revenues, right? And you can see here that they've expanded their revenue significantly post-COVID. Everything is good. But if you look at it on an EPS basis, or even an operating income basis, one of the problems that Google had was that they overhired the crap out of people during 2021, and that really impacted their EPS going forward. So a lot of people who had this forward EPS guidance of about 6, 7, or 8%, they had to walk it back significantly to almost $4.50. And that's why Google took a giant tumble, right? But what's also interesting is, in the first part of 2023, that's when they started to do all the layoffs, and they're able to, at the same time, do share buybacks, right? So one, their operating income jumped up, and now they're actually starting to recover this way. And so it's very important. This is where you have to look at the qualitative parts of the business, and see, like, hey, what's actually going on with this business? Let me just log into Alpha Spread and just show you what I mean. What's actually going on with these companies, and what is the company doing to arrest this decline in EPS, right? So if you look at their operating income on a this is on a quarterly basis, you see that giant leap in December of 2021 and how it dropped almost $3.5 billion. So yeah, of course your EPS is dropping, even though your revenue was climbing, because you had hired all these additional people that weren't providing necessarily value. What's good is that if you look at it on a TTM basis, since December of 2022, last year, their operating income is starting to recover, and is recovering nicely. And at the same time, their EPS is being jumped up because they're doing a ton of share buybacks. So if you look at their buyback numbers right here, and they only started their buyback in let me just go to their cash flow statement. If you look at their buybacks, they only started that in 2019. So they have a ton of free cash flow that they're generating right here in the net issuance of common stock. You can see here that they have bought back about $60 billion worth of common stock. So not only did they lay people off and saved a whole bunch of money on non-productive, I don't want to call non-productive employees, but basically employees that weren't providing necessarily the value. As a shareholder, per share, your EPS is growing significantly. So you can see here right now, they're doing about 15.8 last quarter. This is probably going to get upsized to about 16, maybe 17 billion in the next couple of years, which means you're looking at not just a $60 billion buyback, but almost $70 billion buyback in 2026. So that right there would mean that your EPS target of about $8 or $9 is not that hard to come by. I think $8 is a good amount. And so if you look at on a forward basis, right, and you value it based on based on current, which is about 25 billion, you can see that this easily can get to $200 without really much issue. So at $8 of EPS, multiply it out by 25, which is their typical PE, you got yourself 25 times 8, which is $200. You know.
And I think a lot of people, maybe they have this lens, maybe they don't. And I used to think it was like an just a single company sort of problem. But what I've recognized is it's a more of a people problem. And what I mean by that is going back to what you're talking about with Google, when there's inefficiencies and things aren't happening appropriately, I think the thought is by management to just throw more people at it. And really what the problem is the processes that are set up in the organization are inefficient. And so when you throw on more people on an inefficient process, now not only do you have a bloated organization, but you have more people having checks and balances on inefficient processes, and it all just kind of like gets hidden because you have so many managers looking after these inefficient processes. And this is something that Crossroads and I talked about. It's just like, at almost, you have to bring in a new culture and swing the pendulum the other way to say what we're doing is not focused. We have to align to our purpose. We have to get rallied back in. And I think that's what Google's trying to do. They're trying to trim off some of those things that have maybe lost them some focus. And they're trying to zone back in on the things that are important. And you can't do that too much, because while you need focus, you also need to innovate. And so it's a very difficult thing to keep running businesses, specifically in the tech world. But I see it all too often where it's like, people will, companies more specifically, will get ahead of themselves. And one of the things that Crossroads actually, I was able to talk to him for 4 hours today. It was a really good conversation. We got some barbecue. I went over to his neighborhood. It was like a 40-minute drive for me, but like he was just like, is the left hand talking to the right? And I was like, interesting. So I started thinking about my personal bias and experiences. And I was just like, well, sometimes the person that's deciding the budget isn't actually the one that's in the operation realm. And so this person in the operation realm might say, well, this could save us $10 million. So like, but it's going to cost us $2 million. So let's not spend it because it's going to cost us $2 million, even though we're going to save $10 million down the road. And it might be because that person on the right hand didn't articulate it appropriately. They might have just said, it's going to drive efficiencies, it's going to do X, it's going to do Y, it's going to do Z. But this other person just sees that headline number of $2 million. And sometimes it's like, I've seen this happen in companies where they're like, oh, everyone's so happy, the company's doing so well. And then it's just like, well, they don't give us free coffee anymore. And it's just like, well, how much did the free coffee cost the company? It's like, it might have been like $2,000 a month, but now everyone's pissed off. So it's like, was that $2,000 a month expense really that important for you to lose the happiness of your employees and destroy your cup, like get your employees all grumpy? Like, don't mess with somebody's caffeine, man. Like, that's just like MO number one. So it's small things like that where I think companies will have too many checks and balances where they end up not having the right ability to make the right decisions, because the decision for them is cutting costs, whereas the decision for this person is making sure things operate smoothly. And sometimes they just don't mesh. Sometimes in order for things to operate smoothly, you have to spend a little money, So that's just an interesting piece. But going back,
Did you see this news, by the way, that like all of these shippers are now going around the Cape of Good Hope instead of going through going through the Red Sea?
yeah,
I
I
didn't
don't want to
know
talk
either.
about it too much.
Mhm.
But I mean, we could talk about it briefly, or I'll let you talk. But I can't.
Okay.
It's specifically whatever article it is. I might have to be cautious about what. Uh,
Okay, I understand. No, this one is container ships. It's not tankers.
okay.
Um, so even container ships right now, a lot of big lines like Maersk is a
Yeah.
big shipping lane. They're rerouting all of their ships to the Red Sea. So that additional time and the additional cost may end up wearing on goods inflation, which has been one of the biggest declines for us. So I'd say we have to be very careful in this time. Um, yeah, we have to be just very careful, because if you think about how shipping works, things get produced in China, they go through the Straits of Malacca, around India, or through the Suez Canal, and then to us here on the East Coast. Sometimes what happens is lines will go from China and everything else through the Pacific and end up in California, and then get rail linked to here, right, to the parts of the U.S. So a lot of global shipping is being impacted by this, and it's a very interesting development that we're seeing right now. So I'd have to be very careful with how much things are coming across. So
Yeah, and I
be
think where you're
interesting to see.
getting at is that it's going to lead to supply chain disruptions. You stated that, but in goods, energy prices, there's a lot of energy that rolls through that part of the world that goes to Europe. And if that gets disrupted, we all know what happened in Ukraine and Russia. Like that wasn't really even a disruption to the US fuel supply, but yet oil prices went through the roof and natural gas prices went through the roof. And a lot of that has to do with just normal supply. And that didn't mean that people were like the amount of supply in the world had changed. It was just the flow of the supply had changed. So, that alone is what drove huge increases in the oil price last year. And so, that being shut down or certain companies not being able to run through there could cause some problems for supply chain, and obviously that has an
W-
impact for
One
let's just say some of the economies in the Middle East and not being able to sell to European
w-
nations.
one of the biggest problems though is that, with Russian crude pretty much getting hit with the $60 cap, right? One of the things that we started to see was India kind of, India's always been a long-standing ally of Russia. So, and the Europeans kind of like, the Europeans, like, they talk out of both sides of their mouth. You ever notice that? Where they'll say, like, oh, we're here, we're gonna do everything, we're gonna put sanctions on Russia, but they also allow a lot of shit to happen right under their nose because they know that they need the cheap source of energy. So one of the things that not a lot of people know, but basically what the Russians do is, let's say there's an embargo against Russian oil above a $60 price cap, which means that you can't theoretically buy oil from the Russians for over $60. Now the Russians, of course, have a shit ton of oil. So what do? They essentially sold cargoes through a shadow fleet to India. And so these tankers would go to India, get refined, and then the refineries in India would put it onto product tankers and send them back to Europe and sell them the fucking finished goods. Now, even though the original raw product that was being shipped was Russian oil that's being refined in India to be petroleum, it's a very weird way that basically the Europeans can get around this whole thing with, oh yeah, we're supporting the war in Ukraine. So just a very interesting dynamic. And
Mhm.
so one of the biggest problems now is that now not only do ships have to go one way, have an issue, they got a problem with going through the Red Sea now too. So now it doubles the time. So now you got a ship from Russia all the way to India, get that shit refined, and then bring it all the way back. That adds to the total cost of fuel. So, it's just something very interesting to think about. And the Indians are happy to do it, by the way. The Indians are all about, yeah, give us that cheap oil, we'll refine it to you and sell it to you for a higher price. So
Mhm.
that's where a lot of people have been making money. And like I said, this is one of those things that's not necessarily highlighted by people. And if you don't do the in-depth research, you wouldn't know that. But it's a very interesting thing. So right now, the Russian economy is not nearly as bad as people think. It's actually surviving okay, primarily because the Russians have been able to sell their energy to other people in order to float their economy. So if you look at the ruble price isn't that bad off. Um,
Now the ruble price has been okay, and I think the U.S. News journalists ran with it like it was hotcakes right after the sanctions, where the ruble price was like
mhm,
decimated. But
yeah,
as soon as they started being able to sell, like the ruble price was able to kind of rally back very quickly,
yeah.
more than I think the U.S. would like to admit.
Yeah, I mean, it's a part of how things work, man. It is what it is.
So there were some questions about ABCL, a few other things in here. I don't know if there was anything in particular, but ABCL is up from when we bought it, 35 odd percent. It's still in the portfolio. I started to purchase some as well. And I think one thing that maybe people should recognize is like this is an intermingling of two different ideologies. Like some of these are my positions, some of these are Chris's. So,
Mhm.
not to say that one of us is wrong or
Well, let's
indifferent to the
go
other.
through each one and see like which ones each one of us has picked and the bullishness that we could have. And some of these are joint bullishness, like
Yes.
Abcelera. Yeah,
Yeah. I've done some
Abcelera.
DD
Yeah,
and you
yeah,
told me about it and I did a little bit more research on it and I like it. I think it's a
yeah,
moonshot, but it could be something that
yeah.
does really well.
So Abcelera is a moonshot in pharmaceutical drug discovery. The business model is like they're flipping the script. They're not like, hey, we will find a drug and we will get it to marketing and we'll do all that stuff. It's more like, hey, we will do the research and then we will essentially sit back and you just pay us royalties. So it's almost like the model of a Hollywood agent where their job is to go out there and find talent. And then the rest of the time, the studios are paying the star, but the star also that agent is getting paid a commission for finding that person in the first place. So it's a
Mhm.
lot easier and durable model compared to the other things. So that's one. American Tower is one of my picks because I felt that 5G is going to be a big thing, and American Tower is one of those companies that's undervalued relative to its to its historical performance. Same thing with Brookfield. Brookfield is a preferred equity stock in the commercial real estate space. Um, Dutch Bros is a both like me and you both are in Dutch Bros primarily because we like the coffee. We think that hey, they have a business model that can be scaled up and basically end up providing good returns for us as
And I
investors.
want to state as well that all these have different time horizons, right? Like
Yeah,
Accelera is kind of like a who
10
knows time
years, 10
horizon,
years. Yep.
and then like BPYPM, that's something that I think is at the moment like 2028 or so, or no, this one's
Yeah.
2020.
I'd
Is it
say
in 2020?
2026,
Yeah,
2026. But the key to Brook that one is that you're also getting a really juicy dividend. You're
yield.
getting about a
Yep.
13% yield on it.
Yep.
So
ANT, that's probably like in late 2024, depending on what
mhm,
happens with it. That might get trimmed, in the next year. But I guess it all
yep.
depends on what's happening. In the meantime, it's going to pay us a good yield. Bros is one of those ones where we're going to hold it, over time. And one thing that I'm cautious about on Bros, and everyone's like freaking out, they think Bros is going to zero, is this Cosmics deal. And I think there's not really going to be any big problem until maybe late 25 or early 26 with Cosmics. And the reason being is they just got their first store opened. Yes, everyone's excited about it. Lines around around the parking lot, 3-hour wait times, etc. But they're only opening up 9 stores in 2024. So when you compare 9 stores versus 800 stores and growing 100 stores a year, it's like, well, okay, so even at the end of 2024, there's only going to be 10 stores in total. It's like, well, what does 2025 hold, right? So the competition is several years behind. Even if it does, it's going to take some time for it to catch up. And so that's something I'm keeping in track of. But I don't think at the moment it's going to slow Dutch Bros down enough where it's going to have an impact before 2026, 2027. And even still, I think that's like a big if, like, so what I will be cautious of though is watching McDonald's and see how they're doing. And that could actually help prove Dutch Bros model, but also could have the competition piece into it. But we're several years away from it really having a bottom line impact.
Yeah. Yeah, I mean, and some of these like Extreme Networks and HashiCorp, those are two plays on recoveries of two really great technology companies. IWR is just a play on some short-term bullishness, probably a 1-year mark for recovery in the mid-cap space. Next decade is a decade play for us at this point, but you can see our allocation is very, very small. It's only $1. We've only allocated $1 to it,
$1.
and we're going to keep adding to it, but it's going to be
Uh-huh.
very small amounts over a decade. So someone said, Chris, what's your time horizon on a decade and on next decade? I'll be like, yeah, it's a decade.
You said that in the Discord. I thought it was pretty funny. You're
Yeah,
like, a decade. And somebody laughed. I was like, but he's not trying to make a joke. He's being
yeah,
honest,
yeah.
right? So
And
that's
then
the thing is like that one's dependent too. Like you might see next decade jump up next year if they sanction
mhm,
the 4th and 5th trains, because that's where the real money is supposed to be. But of course, that's all reliant upon do they have to sell down more equity and all
yeah,
that stuff, right? So at the current thought process, it's going to print money if they get the 4th and 5th trains online under budget, on time, which Bechtel does a really good job. And that's the contractor that's actually building out the trains. And somebody actually asked me, like, can you explain what the trains are and stuff like that? It's like, maybe we should,
Can you
maybe
take
tomorrow.
Can you take Heinz's thing off? This way it doesn't block the rest of our positions.
And somebody asked in the comments, so maybe tomorrow when we talk about ET, because I got Steve coming on tomorrow to talk about ET, because we had some people request. Maybe we can go off on that. I know they're unrelated. One's pipelines and one's LNG specific, but they kind of help each other out. They're symbiotic, right? Just like a lot of these oil things are. So I'm all about next decade. One that I also recognized, and it kind of plays in with folks that are all about end phase and the renewable side, is Ørsted. So I bought that one. I think that's one that I think is very long-term focus. That's offshore wind, specifically Danish offshore wind. And they're the number one offshore wind utility provider in the world. And so they have contracts in Europe, the eastern part of the United States, South Korea. I think they're having some stuff in Japan as well. So I think that this one is either 2025, the Danish government owns 51%. They might sell a portion of it, but they might also hold it. But I think in 2025, if that happens, it could be up for acquisition by a major oil and gas company, because at the moment it's a pretty small company overall. So that's, I think, a long-term play. Offshore wind, I think, is something that's near and dear to a lot of people's minds, and being forced by governments to kind of hold all these offshore wind leases. So just some food for thought there. You're a big guy on Oxy because of everything that was kind of going on with Warren, but even still, I think you were just a buyer before then. I'm kind of a believer that I think that oil might be down here for a little bit, but that has kind of changed with the continued. There's the thing, you talked about it on Finance Junkies, which I agree with. It's like you see one domino fall, then you see another domino fall, then you see another domino fall. So it's like I've seen the third domino fall that point in the direction of, because obviously it was OPEC wanting to cut production rates. The first one was the Strategic Petroleum Reserve starting to get filled up again. And this third one has kind of been what's going on in the Red Sea. So I'm like, and obviously what's going on in the Middle East in terms of, just normal, not normal warfare, but just what's going on with Israel and everything, with Gaza Strip and everything like that. That's been a piece of it as well. So it's like, at what point, what's going to be the straw that breaks the camel's back and brings oil prices back up to the $80-$90 range? So
to some degree, I wonder if the Houthis are being paid by the Saudis, even though they're natural enemies. The one enemy that they both share is the low oil prices.
Yeah,
it's a conspiracy theory, but it's still, it's a valid one.
I forget, damn it, I'm gonna screw up the enemy of my.
The enemy of my enemy is my friend.
Exactly. Yeah.
Yeah.
Rocket Lab is mostly mine. I don't know if Chris knows much about.
No, it's
Rocket
mostly you. I'm not really into the space companies just yet.
Understandable. So. I think it still has high risk associated with that one, but I think that one's a 5-10 year play for me. Telz we talked about, that one's a couple year play. We'll see what happens with it. It might get bought out before then.
I think that one's a 6 to 9 month easy. Just wait and see. They don't have enough cash to continue past 2025. Even on the upstream side, the business is not profitable enough to see them through 2025. So either one of two things happen. This goes to bankruptcy, in which case now the bondholders have some equity stake and they have a pretty good amount of assets there, and we may end up getting our money that way. Or the other way is someone picks up the steam and buys them out, in which case now those bonds become fully due right away. And it's not a large amount. So someone buying them up is going to just pay out the thing, and we end up getting $25 for something that we paid $9 or $13 for,
Yeah.
you know,
Yeah.
and the entire time we'll be collecting interest payments. So we'll see what happens. Next year will be very interesting.
And TQQQ, that's what I call my speculative yacht fund in my personal portfolio. I actually have a list of, if I were to die, I actually tell my family like what I want them to sell and put my money into. And
Mhm.
this is a very small portion, but I basically say there's 4 different funds, SPY being majority of it, TQQQ being 5% of it, where I basically say, you know, in the SPY, and then there's 2 other funds that are just like, let this just like always own this, take the dividends, you know, use the dividends, leave the principal alone, let it grow. But the TQQQ piece where it's like, if it ever gets to be more than 20 to 25% of the portfolio, sell a portion of it, put it to the other 3 funds. And then my other thought process is if this ever gets to below 5% in the portfolio for TQQQ, add up to it. So if it let's just say there's an 80% decline in TQQQ, which has happened several times, if you put and make that go up to 5%, when it rallies back, it's obviously going to have a roaring return, right? It's up over 100% in this year alone. We bought it at the tail end. It's up almost 40% since we bought it close to the end of October, early November. So if you time it appropriately, it's triple leverage. So if it'll do good on the upside, but it'll also really rip you hard if you hold it in the opposite direction. So this one is kind of like you're playing with fire with this one, but it's kind of that one where, to me, if you hold it over 10 years, which I don't advise, or you know, I can't advise anyway, but I don't think anyone should do unless you want to lose that money, which to me, I'm okay with losing that money and in hopes that it does this. But triple leverage return on the NASDAQ 100 over the course of 10 years is probably going to be okay.
Yeah.
There's a high likelihood that it won't be, but to me, I'm okay with taking that risk to put a 5% portfolio weighting, because if it does have 5% and it does go outsized return comparatively to, say, the SPY, it'll show up as a 20-25% of the portfolio. You trim some of it, put it back into the easier, less volatile stuff, wait for it to, you know, come back down, maybe add a little bit in down markets to TQQQ, and then just, you know, play that cycle over and over again. And had you done that over the past 2020, 2022, when you've had some recent pullbacks in TQQQ, you've done extremely well. But don't get greedy with it, right? Don't be adding it to be 20% of your portfolio right here, because we're getting closer to all-time highs, right? Who knows? We might have a 5-10% pullback, and next thing you know, you sell it because it's down, you know, 25% in the matter of a couple of weeks. And it's like, well, we told you, you're playing with fire, right? Just be cautious with that one. And then Verizon.
Yeah, and Verizon is probably a 2-year play on a recovery in you'll see. We've gone through it. I have to head out though because it's 11, so I'll talk to you later. All right, have a good one, guys.
Guy. Good talking to you.
Bye.
I'll answer a few of these questions and then I'll head out as well. But always good to have Hot Chris on. He's the man, myth and legend. I see people talking about Popeyes. It is what it is. Let's just see. So tomorrow, I guess also, while we have 120 some people in here, be sure to, if you haven't already, follow the Cashflow Chronicles TV YouTube channel. I just put it in the chat section. It's also the pinned comment, and also the link is in the description. Please go ahead and do that. Chris eventually and I will move over to that channel full time, and I actually might put this replay on there so people can start to trickle on over there and watch the replays and everything over there. So it should be good. Let's see if there's any questions in here. Talking about oil. Let's just see. I really like how you think of your family, Matt. I wish to no harm, but it's really cool that you do have that plan to educate your viewers. That's actually why I started my YouTube channel. was because I just like assumed that eventually I'd have this family I needed to share it with. I had like kids in mind initially, but my thought process was, it's like if they had this channel to kind of look through all my like steps and progress in these videos. I didn't really think of the live streams back then, but the thought process is like when I first started making $100 a month in dividends, I was like, wow, they could look at this $200 a month, and then it got to 1,000, and all that, and it's documented throughout there. So they literally have a catalog, and it's actually pretty cool because like my dad, he passed away 2 years ago, but when it's kind of cool to be able to look because he wasn't really much into investing in traditional sense of like stocks and real estate. He was very much like a guns, cars, engines and stuff like that. So all those things hold their value, but they're more collectibles, right? So it's cool because he had a small YouTube channel where we'd like, write some comments and stuff like that. And it never got to the point where it's thousands of viewers or anything like that. But it was just really cool because he was able to show, hey, like I'm selling this engine to this guy, take a quick video, and you get to see the engine and you get to hear him and see his passion. And it was really cool. And I tried to encourage him to do more of it because I thought it was really awesome. And I think that there was a niche for it. And I hoped that he would pick it up the more he got closer and closer to retirement. And he never did. But it was always something that I really pushed him to try to do. But it's cool, that documentation piece. Like my nephews come and watch it every once in a while. I was home over Thanksgiving. They put it up on the TV. I don't think they actually watch it much, but if you do, hello. But I've had my sister jump on from time to time. But it's pretty cool. And I think at the end of the day, what they'll realize, which I don't think that they know at the moment, and I've kind of hinted at it, and they know to an extent, but I don't know to what extent. Let's just say, unfortunately, I got hit by a bus tomorrow. I don't think I will, but you never know. They have that, right? They have it written down. They know where a majority of the accounts are. They have the account number, stuff like that. So they have the death certificate. They can get all access to all that stuff. But like they'll be able to see, wow, what did Matt do? Like how did he get here? Because I'm 32. Normal people probably wouldn't have gotten to the place that I've gotten to, but this is my hobby. Like I love this. This is why I'm doing it. So in that respect, I mean, it would be a disservice if I kind of kept that and didn't share. So, but this one, I wanted to say this when Chris was walking through the indices. If you saw, VNQ underperforms comparatively to, say, the S&P and maybe some of the real estate investment trusts that you guys are used to seeing. So you have to consider sometimes these things may be indices, but you have to recognize is like specifically for some sectors, when you invest in some of these sector ETFs, there's going to be companies in there that are subprime. And so what you might recognize, like I think a lot of people, they invested in XLE, which I think is like the Spider Energy ETF. And a lot of times that's oil and gas companies. So when you had the pandemic occur, you had some of these bankruptcies. Well, unfortunately, those bankruptcies are also going to be realized by investing in something like XLE. So, yes, you'll have the returns of Exxon and Chevron and Shell, which are able to kind of stabilize that. But still, you're going to have some of these companies that unfortunately went bankrupt. Like you're going to have Seadrill. You're going to have companies that didn't make it through. And unfortunately, a portion of your money's in that. So 80 to 90% of your money is probably in good, stable companies, but that 10% is going to be gone forever. So even if your other companies get back to normal and get back to where they were, you're still going to be 10% down because all those other companies went belly up. And so you have to think about it when you're investing in some of these ETFs. And hopefully that's a lesson to think about. It's like, that's part of the reason why the S&P is so good. Because it's not just 500 blanket companies. It's 500 blanket companies that are currently profitable, have been profitable over the last 12 months, and are selected to be entered and exited out of this special club. So it's like an actively managed mutual fund of profitable companies. And so the benefit of it almost is if you have a company that all of a sudden like goes belly up, and it takes a while for some of the times the oil and gas companies to come back into the S&P 500. because they have these pockets of cyclicalness into the commodities market. And when those companies decline so much and they start hitting negative profits or just they're losing money, they get kicked out of the S&P. And so when they get kicked out of the S&P, then they, generally speaking, crater, and a lot of those losses aren't necessarily reflected within the S&P 500 because they've already been removed. So you have to think it's almost like a shield, So it's like you might not be able to pick the best stocks, but you're also not picking horrible stocks because they've been vetted, they're profitable, and so that's kind of the thought process between the S&P 500. But I still see all these people trying to pick the ones that are always the best, and sometimes it gets them into trouble. Yeah, it's why majority of the time, it doesn't last. Funds don't really last, When will Robinhood let you buy bonds? I think the bonds, uh, good opportunity if you need the money in the short term. But, I think right now, really the thing is that I would focus on is just continue to invest in the S&P 500. This is the thing. I think a lot of people, the majority of people, 90 to 95% of people watching, need to just invest in the S&P 500, and not even the S&P 500 or SPY, I should say. Normal people should invest in IVV and VOO, and reason being is because they're not going to pay enough attention to what's going on in the markets to truly make outsized returns. Like, unless you put in the due diligence of a Chris Patel or some of these other people that are literally spending 40 to 60 hours a week, if not more, researching specific companies that are out of favor, out of value, what they're going to next, you don't have a competitive advantage. And so it's going to be very difficult for you to just whimsically choose a stock. And I think a lot of times you think you can just follow a YouTuber and they've done all the due diligence. Like, well, nine times out of 10, I'm just going to be honest, myself included, those guys are talking about particular stocks that might not align to your investment thesis. And second, there's going to be people that show up out of left field because they know a stock gets a lot of clicks, views, and oversight. So, like, people are making videos on Tesla, just because they want to make videos on Tesla and get the views, not even because they believe in the stock. And so I know plenty of people that legit will pump certain stocks and tickers to just get those views rather than actually believing in those companies. The amount of people that I guarantee when SoFi goes on a massive, massive bull run, I still see it on X today, where it's like people will say, hello, good morning, and they'll tag Palantir. It's like, you're saying good morning. Why are you tagging Palantir? Unless you have something insightful specifically about the organization, like, stop cluttering up the Palantir timeline. Like, talk about something that's actually productive. They're doing it to clout chase a lot of times. And so it's kind of somewhat frustrating. I don't mind people that are actually contributing to the conversation positively or negatively, but, to just say hello, good morning, and tag Palantir, like, this doesn't make sense to me sometimes. So we're going to start to see the same with Rocket Lab, and many of these other companies are getting just to profitability. And a lot of it's just because they're catchy, right? And, I've been invested in, that's why I don't invest in SoFi. Like, I'm not investing in SoFi, not because I think it's catchy or anything like that. I just think that there's other opportunities out there like Rocket Lab, Palantir. I think Dutch Bros is a good one. But I think a lot of times people will just be like, oh, I need to invest in SoFi. I need content for my YouTube channel. It's like, that's not the way to invest, right? The way to invest is actually do the true due diligence and invest in companies you truly perceive are good. But I still see, unfortunately, a lot of people chasing clout. And those are the people that do a little bit of disservice to the content creation piece. But I'd say 95% of you guys should just invest in the S&P 500 unless you're truly going to look on a weekly basis at a minimum and spend an hour or two every week, balancing the portfolio, understanding what's going on. And another piece is like, you don't have to swing at every opportunity just because, Vitaly thinks that Enphase is a good opportunity doesn't mean you have to swing at it, right? Does it fit into your portfolio? You might be 60 years old and not need to get the growth of a Palantir, right? You need to be focusing more on potentially focusing on like a SCHD or like a dividend ETF that's going to yield you 2.5%, 3%, right? So to make sure it's personal finance for a reason, and I hope everyone kind of takes that away from what I've just been talking about. But I think that that's what you need to really focus on is it's like, yes, this seems really interesting, but how does this help me? Right. And Jeremy said it perfectly. Um, when we had our like talk about Palantir and SoFi and Enphase, and I forget what other companies, and he said something about Rocket Lab, and he asked me about it, and he was like, "Is it an unprofitable company?" And I said, "Yes." And he straight up said, "He's like, I don't invest in unprofitable companies." I was like, "Fair enough, right? Like, I get it. You know, there's an ability when something's profitable that it makes it a little bit easier to evaluate on a fundamental basis. And if it's not profitable yet, it's going to be more difficult to do so. So, if I'd say for 90% of the people, if you're sitting here being like, I don't understand X, Y, and Z that Matt and Chris are talking about, you know, there's a couple stocks within our individual portfolio that I personally just am not fundamentally aligned with, but it's part of that's Chris's money as well. So you kind of have to balance between the two. And so the thought process is like, what makes more sense for you? I like the 5 to 10 year plays, and Chris likes to move around a little bit. So sometimes, just because we had the portfolio split, like you have to recognize each of them is going to be showing up very differently. Like unless Orsted shows up and increases by 100% tomorrow, I'm not going to sell the stock. And same thing with Rocket Lab. Like I'm not going to sell it when it goes to up 50%. I'm hoping that it goes to a $50 billion company. So that's where like the thought process behind some of these things lie. And you have to recognize it's like when somebody enters a stock, they also likely have an exit in mind as well. And if they don't, you probably shouldn't invest in the stock personally. But you also have to recognize how does this person and where they are in their investment journey and their perspective as to what they're putting into their portfolio pertain to me. And you could straight up be a 20-year-old kid, just a little bit younger than a mid, and be like, well, the way that Matt's investing is kind of old manish. Like he's 70, 80% SPY, and he's focusing the rest on individual securities that I think are going to be outsized returns. And so that's too hands off for me. I have 80 hours a week to dedicate to this, and I have the opportunity to put way more effort in than say the majority of people. Then I'd say go for it, my guy. Like I would say, if you think you have the ability to come up with a competitive advantage because of your time and expertise and knowledge in a particular field, like I would say go for it and give it a shot. But what I would also say is like recognize where you have faults. And I think a lot of times we are, as a human race, human species, we are very bad about judging risk. And I've noticed that, and I notice that more and more the older I get. And whether that's just my personal day-to-day job about investing in projects that we do at my day-to-day job. And then second, just investing in the stock market as well. Like we honestly downplay a lot of risks. And I think when we were like, oh, it could go to zero, but it's not going to happen. It's not going to go to zero. And it's like, well, you have to think like over the course of the next 300 years, the majority of the companies we are talking about today will either go bankrupt, merge, or file for bankruptcy. Go bankrupt, merge, acquire something else, or just pack up shop, right? Like, so you have to think the majority of the companies, we generally speaking don't talk about companies that have been around since the 1600s. We talk about Apple, Microsoft, which have been around since the 70s. So they've been around getting close to 50 years now. Like, come on. Like those are, we might talk about the GEs of the world. We might talk about the oil and gas companies, which have been around since the late 1800s, early 1900s. But very rarely will we talk about a company that's still around since the 1700s. And so you think about it, most of the time, those companies get bought out, bankrupted, or just cease to exist. They call it a day. And you have to recognize is like you have to ebb and flow sometimes. And if you can't, that's why it's nice to just invest in the SP 500 because it'll do it for you. So you have to recognize, like, will you have the time to dedicate to go into those ebbs and flows? So that's, it doesn't matter what I'm buying in the portfolio. It matters what you need to buy in your portfolio. And is what is Matt buying aligns to what I'm doing. And trust me, if I just like got up here and cheerleaded all the best stocks in the stock market that you should buy this ticker symbol today, I would have hundreds of thousands of viewers on YouTube. But unfortunately for you, which I think that most people would enjoy that in the short term, and the long term, the people that are following and actually watching this are benefiting way more than me just saying, buy Rocket Lab, buy Discover Financial Services, buy X, buy Z, buy Tesla, it's going to the moon, and being that cheerleader. Because I'm the one that has to wake up and look myself in the mirror every day and come up here and like look at myself and edit the videos. And if I just did that and just like spouted it off, it's like I might make a little bit more money. But one, I don't really need the money. And two, this is educational. This is for my family. This is for me trying to help people. This is me trying to get back to the world and learning what I learned. Because back in 2017, 2018, when I started on YouTube, there wasn't many people doing this. On like there might have been Jeremy, Ryan from Independent Investor was doing some stuff. Ryan Scribner was kind of just getting there. Meet Kevin. So it's like, they were a little bit ahead of me by like 6 months to a year. They started probably in the maybe late 2016, early 2017 timeframe from a finance perspective. I started in late 2017, early 2017. I don't remember. But it's like those guys, I'm not saying that that's what they did. They have great content. Graham has great content. All those guys did a really good job, and they were very persistent, and that's where they got to where they got to. Like I see so many people that are able to grow from 0 to 50,000 just because they cheerlead certain stocks. And then when those certain stocks don't do well, or they don't make enough money because they realize it's very difficult to make money on YouTube, they stop making videos. You mean it's hard to make more than $1,000 a month on YouTube? Yeah, it is. And so when they put all this time, effort, they get to 50,000, they're like, this isn't as much as I thought it was. They quit, or their stock goes to zero and they have to find another one, Do I think Google will offer dividend in a few years? I don't know about a few years, but I'd say in 10 to 15 years. I want to know why Chris thinks Accelera is a good investment. I don't think Chris thinks it's a good investment, right? I think what he thinks is that it's a opportunity for outsized returns. And, it might have a very low likelihood of getting to a place, but of being a good, like an actual massive return. But I think the current market cap of it is less than $1 billion. Just double check. It's $1.5 billion since it's been on its run. And it could be something that eventually goes to a $200 billion market cap, $150 billion market cap. So if that's the case, if there's no massive share dilution or anything of the like, it could be a, 50, 20, 100x, right? And so if you have, let's just say, a couple grand, to us, that's not a lot of money. For you, 20, 30, 40 bucks, or maybe 50 bucks, or 300, 400 bucks, and that goes up 100%. It's like, well, not 100%, 100 times, you turn 400 bucks into 40 grand. That's awesome. But, it's going to be low likelihood. So you have to recognize it's like not every stock symbol here or that we show on the portfolio has the same risk reward. When you talk about Verizon, very low risk, but the reward might be 50% return. Rocket Lab, higher risk, but 20x return. And so you have to figure out where you fit on that spectrum. Otherwise, so SPY, low risk, 8% annualized return over the course of 10 years, right? You'll have some ups, you'll have some downs, you have some years you're down 20%, you'll have some years you're up 30%. But overall, over 10 years, 8%. Versus an Accelera, in 15 years, it could be up 100x, 10,000%. Likelihood of that happening? Couple percent points. Very, very low likelihood. Opportunity for massive growth. Google could 2x from here. Where it's at could turn into a $3.5–4 trillion company, but it's already a $1.7 trillion company. So 100% return potential, likely, but like, what's the word I'm looking for? It's only 200% return. So you have to see, and that's over time period. It's not tomorrow. You're talking about years of waiting and putting up with ebbs and flows in the market, down 20%, up 30%. I've already been through a drawdown of Google of more than 50% since I've owned it. So if that's not something you can handle, S&P 500, right? Like, these are the sorts of things that you need to literally think through when you're investing. Otherwise, you're going to get slaughtered. I talked earlier in the stream about people that were like, Google's down to $80. I sold. And now they're talking about getting back in at $120. It's like, my guy, why did you wait until it got back to $120? Like, people have this negative mindset where they can't even think about it. Oh, thank you for the super chat. I just saw that. Much appreciated. You really have to think. Like, so many people bring emotions. Like, your emotions, the market doesn't care about your emotions, right? It's going to be irrational longer than you can stay solvent. I didn't come up with that. That is just known. So the market will retrace Amazon by 60%, Google by 60%, Facebook by 75%, Meta by 75%. It was up at $380 a share. It dropped below $100. And so you have to sit there and say, they're making $20–30 billion a year. They're not going bankrupt, right? No. They just came out with the quarterly earnings. They're either the biggest scam and liars of all time, or they're still making that much money. And Chris and Vitaly, when they had the opportunity, they bought Meta. I was buying I was buying Amazon, I was buying Google. I saw Meta and I was like, shit. But I'd already had investments in Amazon or Google, so I doubled down. But it's like, I understand why they did it. I agreed with them. I just was more focused on, I didn't think it was actually going to return back to $300 like within a year, and I'm an idiot. But, I was able to capture at least Google and Amazon. So, I don't know. I think so many times people need to just stay in their lane and understand where they're coming from. And what works for them, because let's just say you want more guarantees, then Accelera is not your company, right? Like, but if you're looking for something where you're like, I got $1,000 that I don't mind losing out of my $100,000 portfolio, if you have $99,000 and that $1,000, like, it could be a month's investment. Let's just like, this isn't, how do I say this and not sound like an asshole? $1,000 could be a portion of a month's of investments. Once you really get into it, $50 might be a lot. Then you're doing it for a couple months. Then $100 is a lot. Then you're doing it for a couple months. Hell, I used to have a $500 investment in Siri. It was one of my, not Siri, Sirius XM. It was my first stocks. And I looked at it like a hawk. Meanwhile, like, I'm like freaking out because I lost $6 on paper and my lunch cost $8. I'm freaking out more about the fact that I lost $6 on paper than how much I just spent on the lunch that I'm eating, discussing it at lunch with, my other first year engineers at UDoc. So it's like, I get it, right? You have to build that tolerance. You have to build that emotional intelligence about what's truly going on in the markets. And that's probably the most important thing, is it's like, if you don't want to do that, that's okay. Like, you have an out, and it's the S&P 500. So it's like, if you don't want to deal with the ebbs and flows, and like, I don't know how many times or different ways I need to say it, but and even still, like the S&P 500, depending on where you're at, might not be the opportunity either, right? Say you're 65 years old or something right now, and you could buy, I don't know how or where, because bond prices or bond yields have gone down pretty drastically, but shit, a month ago, you could have bought a 20-year bond at like a 5.5% yield and just been coasted on that, you know? The only thing you'd have to worry about is inflation eating away your principal. You'd still be getting that 5.5% every year. So I think you just need to understand, what works for you. But I don't think Chris thinks it's a good investment. I think that he understands that, maybe I shouldn't speak for him, but he's done his due diligence. They have a lot of cash on hand still. They're coming up with other opportunities. They're working with a lot of people. He can see a path where, and I can as well, see a path where it has outsized returns. But generally speaking, it's a very risky area. What days we hosting? Tuesday through Thursday, my guy. Tuesday through Thursday. Hopefully we do it a little bit more. My plans to set up trust for the family will design to still grow for the future generations by limiting withdrawals and having buy-in options. I like that. I also think about the same. The problem is getting everyone on board, because I have the same want and thoughts, and my family knows I'm very financially intelligent, and I try to help by rallying. After my father passed, I try to rally everybody around, but unfortunately, you have to get everyone on board. And unfortunately, when there's money involved, there's emotions. And unless you're the one that's entirely in control of all of it, then it's going to be very difficult to do. I try to do the best by my family. I try to make the best opportunities and help where I can. I'm not going to take the family's money and invest it in Rocket Lab or, what's another one? Tell Z. Like that. I'm going to choose something that's very safe, long-term, stable investments. But unfortunately, you have emotions to deal with, and unfortunately, you can't always do the right thing by everybody. And unfortunately, that's just, managing emotions and everything like that with investing is tough. But if you have the ability on your own to do it, then I would suggest absolutely, while you can, put it in place. Generational skipping trusts are also a thing as well. But I think having a firm, one of the things I've noticed, having a firm acknowledgement of why you're choosing things and investments will go a long way. We didn't have that, unfortunately, with my father. We didn't really have that, unfortunately, with my grandfather. And so opportunities to see how money should be invested going forward, you don't have that guidance. And you personally might be prudent by investing and being able to do a good job. Those who get the money after you will be more concerned about putting their kids through college or stuff like that. And what they don't recognize is, what's the word I'm looking for? What they don't realize is cash is very fragile, and it's more about the cash flow than sometimes the total position. And reason being is, it's like, once that position is spent, it's gone. Like, if you get 100 grand and it's not managed appropriately, it's gone, and it can be gone very quickly. And I've seen literally hundreds of thousands of dollars of people's inheritance just absolutely disappear because they don't manage it appropriately. Versus you could set up a stream of income of, say, $3,000 to $5,000 per annum, and it's like, well, what's more important to you, this $100,000 today, or making sure that you have $5,000 a year for the rest of your life? And I think a lot of people will choose $100,000 today versus the long term. And I guess it's very much dependent on what their life circumstances are. $100,000 is not really life-changing money. It might help you out of a bind, but $5,000 a year, it's an extra $400, $500. It'll pay for cell phone bills. It might pay for a car payment. That's the sort of stuff that allows you to kind of skip by, and maybe take a portion of that and get yourself out of Dodge. 50 grand can be helpful enough to do something like that. But anyway, Austin, one of the people in the Money Gang. Gang. Thank you, as always, for being part of the Money Gang. The Cashflow Chronicles portfolio is a thing of beauty, and getting behind the scenes look at monitoring, reevaluating, updating weightings, etc. is invaluable. I agree, man. And I think the part that I think, thank you about the condolences about my father as well. He's a good dude. I learned a lot from him. We're different people, but at the same time, the apple did not fall far from the tree. The thing is like it's somewhat confusing, which I hope Chris, when like we continue down the path of hopefully getting the ETF piece set in place, it's like Chris will have his ETF, I'll have mine, and they'll be very different. But you know, I hope that people don't just look at the ticker symbol, take it away, and like go and buy it, right? I hope that they actually internalize it and digest it and understand. John, how no mutual funds in your brokerage account for trust? They don't reset on a cost basis. Interesting. That's really good insights. Yeah, cool dude. Guns and cars. Yes. My sister said it perfectly the other day. He liked things that go vroom and boom. And I thought that was really well worded. So shout out to my sister for that one. Any of you oil folk looking at PRB? Do you mean PBR? PRB. PBR. I think you mean PBR, which is Petrobras. Let's see if you correct yourself. Yeah. Gina and I talked a good bit in Vegas. She's a smart woman when it comes to investing. Any oil companies outside the big ones, Shell, Chevron, Exxon, Oxy. I think you need to understand what the goal is with investing in these oil stocks. So, and I can't state all the positions that I have in oil stocks for obvious reasons. VLO, is that Valero? I think so. Yeah, Valero. Sometimes these things, these operate differently. I think a lot of times people think Valero, and I'm not saying everybody, right? But I'm saying a general public won't realize that Valero operates on a completely different fundamental business than Shell or Exxon, right? And I think people just need to recognize is like once refining specifically and taking the feedstock and trying to get a margin off of that. What am I trying to think here? What's a good say you're making chocolate, right? So Valero is like Hershey's, right? They're taking a cocoa bean and refining it and doing some things to it and selling the product versus Shell, Exxon, and those folks are the cocoa bean harvesters. And they're selling it to, and sometimes, those guys have refineries as well, right? So there's not entirely, but Valero is more the folk that are dealing with the refining side versus there's the exploration and production companies that focus on the 100 million barrels of oil per day that we produce. And so just understand that the margins you're looking at are very different. And generally speaking, even though oil prices have kind of stayed in the high 70s, low 80s, you continue to see the price at the gas pump continue to go down. So even though we've already retraced back down to the low 80s over the course of, let's just say, the past 6 to 9 months, you've seen the price of the pump continue to go down 20-30%. It's like, well, we only went from the low 80s to the high 60s. Why is the price of the price of the pump down 20-25%? So you have to think that there's additional margin that plays on top of that. That's what really Phillips 66 and Valero and those guys that are the refining piece are all kind of playing for, right? Versus what the Aramcos and the international oil companies are all playing for, which is just the normal, hey, what can we get this out of the ground for? And sell to the Valeros and the other people in the world for. That's the difference. Do I have any Texas Pacific? I do not. Taking account of opportunity costs of all those hours doing due diligence. 100%. Hot TJ, the man, the myth, and the legend in the house. I would love to get TJ on as much as I would, but I do need to get off here in just a moment. So I'm going to try to run through these questions. I recognize I'm 26 minutes behind on these questions. TJ, really liked your question on the end goal during the 6-hour stream. Thanks for asking that. Hot TJ, 220 cash secured puts on Palantir because he decided Palantir simply can't miss. I guess it all depends on what strikes. So Hot TJ said 17 at 1750. Zocold said, don't necessarily agree with you, Matt. That's understandable. People have the right temperament, they can do well in the market. It's not necessarily only research. 100%, man. And that's why I say, like, I'm not saying 100% of people, right? And I appreciate that pushback. I think that that's very vital. The people that can build that tolerance and that emotional intelligence with respect to the market, I agree. But I would say that that's not the normal investor, right? I think that you're somebody that comes on and does a lot more due diligence, right? And so I think it's easy for me to say, well, I think I have a competitive advantage investing in Palantir or Rocket Lab, but you know, I'm not most people, right? This is my hobby, right? Like I do live streams for 6 hours, right? That's the sort of thing where it's like I'm not 95% of the people. I'm in that select 5% where I think I can do outsized returns. And I will be honest as well, there was a lot of times in my career where, and sometimes I even question it to this day, which is why I have the majority of my money in the SPY, where it's like, am I actually that intelligent, right? Because you think about it, it's like, I've been waiting around for how long for Palantir to go to the moon or Rocket Lab to go to the moon? Like, could I have just invested in the SPY and done well, right? So um that's just some food for thought, right? Like I said, I'm not saying that you're wrong, but I think that it's easy to sometimes lose sight of the general population when you yourself have good temperament. And so I deal with a lot of folks, unfortunately, I don't. And I hear a lot of stories of people telling me, oh, they have positions. And then like 6 months later, they say, oh, when should I buy back into that? It's like, I thought you already had it. No, I sold it because. And it's like, well, that doesn't show very good temperament. And that happens way more than you think. People are like, oh, so when the market goes down 20, 30%, if I'm investing in good long-term holding companies that I have a lot of conviction in, I shouldn't sell. Exactly. That's what I would say. And then boom, 2022 happens and they're like, I sold my entire portfolio last week. And I'm like, dude, like we're down 20, 30%. Like just like hold on for a couple more months. And I swear. And the next thing you know, they're selling out in September, October, November. And what happens? Well, the last 12 months is what the last 12 months was. And they've missed out on being able to get back to where their portfolio was at the end of 2021. And so, you know, I understand if you have the temperament, I get it. And maybe but that's a personal thing you have to recognize. And I think that that's harder to do than to say. Because a lot of people are like, yeah, I got the temperament. I can control my emotions. And it's like 19 out of 20 people, I don't think will. And so maybe that's I'm picking that number out of the air, by the way. It could be 18 out of 20 people. It could be 17 out of 20 people. But I'm just saying there's a number between 50% of people and 100% of people, somewhere in between there, where that general population of the majority, between above 50, below 100, that do not have the temperament. So, and I recognize I'm pulling 95% out of the air. That's probably wrong of me to do because maybe it's 85, maybe it's 90. But I'd say majority of people don't want to put in the time. So let's see. Roll Palantir down. Some people like penny stocks, do better with high limits investing. I'm not into SoFi. And I talked about this with Crossroads today. I don't wish anybody bad by being invested in SoFi. I don't wish anybody bad by not being in PayPal. And when I say I'm not invested, it's just like My SoFi exposure is just like, and I'm bullish on the company. I just don't think that you need to be invested in every stock. Like, you don't need to take a swing at every pitch. I have like baby spreads, less than 10 contracts, right? I don't even know. Is it two? It's not big. It's literally for me to like keep track of what other people are doing. Let me just make sure I'm not sharing my screen. Okay, we're good. Let me tell you. I have the 10 and 15 spreads for January 2026. Like, I'm not invested in SoFi, but like it's I'll tell you how big in just this account, how big this portfolio position is. And there's other accounts, right? So the 10-15 call, two contracts, which is in this particular account, 0.11% and 0.17%. So 0.2%. So to me, I'm not invested in SoFi, right? 0.2%, it's nothing. Now you're up 6 figures on Enphase. I'll take a Tylenol. I'll deal with it. I was talking about that the other day. I think you need to recognize that's something you actually want to hold Enphase. Maybe it is, I don't know what the contracts are. It's been a minute since I've looked at it for you. True. I think the best advice is only put in if you're willing to lose. Agree with that as well. Pain for sure. I'll trim you for position around 175. I think 175 is a little steep for me personally, but I don't have the cojones you do, TJ, when it comes to Enphase. So the dollar research and sell, even if the story of the company hasn't changed. Temperament is a big factor. Yep, agreed. So hot TJ. Nanimula, new camera. I stream on Roku, but comment on your phone. Dude, your video looks extra crisp today. Yeah, I bought a camera, a 4K guy. This is only streaming in 720, I think. So I think we have to buy the extra premium or something to stream in 1080. Streamlab would let us do 1080, but Chris wanted to switch over to StreamYard. I personally kind of miss the Streamlab setup. There's pros and cons of both. We'll see where we end up. I think that StreamYard has made a little bit better strides, being able to stream to multiple. Like now you can stream to Twitter and stuff of the like. So cool to be able to do so. What else was I going to say? There's like a few more additions. Like you can have bots and stuff in StreamYard or Streamlab that you can't really do in StreamYard. So talk about Enphase, just barely went positive. Yeah, I don't know much about. I'm just not a fan of Enphase personally. It's another one that I wish everyone does well. I really do. I think that the benefit is on the residential side, not the commercial side. Scribner was your guy who first got started. Should have been you, my guy, but I found my way over eventually. Nah, man. I mean, Scribner does a great job, right? So he does a really good job about laying out stories and being able to tell them. So I don't hate anybody for that. TJ, you're the man. Much appreciated for the super chat. I was wondering who the heck it was. Just coming down to this, and hopefully we can catch up and close this out. Hard to argue with portfolio traded live. People wanting me to push for another 6-hour stream. I don't have it in me. As much as I would like to do so. Let's just see. You're a big PA jersey saying for sure. Oh yeah, my guy's a big PA jersey thing. Maybe not. Yeah, maybe not. I know it's getting really, really big in PA and Jersey for sure. Because I talk about it with my buddies all the time. Because they're still back in Pennsylvania, and that's where I'm from. Let's just see. I think everyone needs to have a loss at some point relative to find their risk tolerance. I agree. You're not going to know until you get slapped in the mouth. True to getting family rallied behind the idea will be tough. You have a great plan to keep them in front. Is all what you're thinking about. I agree. You got to do what's best for you. Oh wow, that's cool. Vivek Ramaswamy removes himself from Colorado in solidarity with Trump. No, I do not have kids. I have nieces and nephews, so it's nice to be able to see them. Just nailed it. I don't know what specifically, but sure. Lots of thought storms running in there. You don't have to do it all, man. Like, you don't need to reinvent the wheel. And I think you need to look at specifically what makes sense for you. And that's the thing. The stock market alone might not be for you. And what I mean by that is, like, I know a lot of people. I have a buddy who is very little invested in the stock market. His wife has a 401k. He's a plumber. He is very hands-on. He has a little bit of contracting skills. He buys slightly distressed properties, fixes them up a little bit. He's also had some benefit of having lower interest rates, other than the last few houses that he bought. But he's got a few houses with some very low cost bases and some very favorable interest rates. And he's had phenomenal exposure to great tenants. And in 15 years, 20 years, those houses are going to be like majority paid off or have a crap ton of equity in them from his capital appreciation. And he can refinance them, buy more homes, sell them, whatever. But he has that hands-on contractor sort of experience. And, don't downplay that. Feed to your strengths. Like, if you are like a computer whiz, you might have the opportunity to set up shop and create a business, right? It doesn't always have to be the stock market. You kind of have to fit within where you think it's appropriate and play to your strengths. So if you like to be very actively invested in your investments, real estate could be one, right? And you can have passive forms of real estate. You can have very active forms of real estate. And so, all very much depend. And there's large rates of return in between. Like, if you're legitimately getting your fingers dirty and on your knees scrubbing crap and recreating bathrooms and renovating, it's like you might be able to buy a house for 250 grand and it'll appraise for 450 by the time you're done, and rent it out for 3 grand a month. And you're sitting there fat, dumb, and happy because you're making a couple $100 a month and you're sitting on all this equity. My entire family, aside from me, pretty much has been doing that their entire lives. Aside from me, I mean, like, my dad and his brothers and sisters were very much into the real estate thing, not so much the stock market. And so there's pros and cons of both. There's the liquidity piece of the stock market. You can buy and sell very quickly versus real estate, high transaction fees, 6%. So you have to take into consideration, but you have to figure out what you're able to do. A lot of people like the real estate piece because it forces them to be more long-term minded versus the stock market. It's so easy to buy and sell that sometimes you don't have that opportunity to get the wavelengths needed to truly make a difference. And I think in real estate, there's the ups and downs as well, but you don't see it as much because it's harder information to get and it's not as liquid. So unless you're looking at the house next door, you're like, crap, I paid 250. This guy paid 225. We lost 10%. Sell. It's like, you don't really know, unless you're in a dire situation and have to fire sale or something like that. So keep that in mind, man. Like, you don't have to necessarily do the stock market. Father lost a lot when Jam went bankrupt. That's what I'm saying, man. You gotta be cautious sometimes. Do you hold Vici? I don't. I do not. I don't think it's a bad one, though. I haven't looked at it recently. Everyone talks about the gender wage gap. What about the spend gap? I have thoughts on that as well. But yeah, she owns all of TJ's money for sure. She's such a nice lady. I met her in Vegas. Sweetest woman. Her and TJ have a beautiful marriage. they seem so happy together. So just excited that I got to meet them both, and I hope to meet up with them next year when TJ gives me the deets about his meetup. I'll be excited about that. Thoughts on Schlumberger? Been eyeing it for a long time, but never got into your buy zone. Schlumberger is one of those ones where you have to look at where spending is. Are people pulling back on spending? Are they getting aggressive in spending? I would say in 2020, late 2021, early 2022, Schlumberger was probably a good one because oil prices were going up and to the right. I would say probably right now, it's actually still doing rather well. This is year to date. It's a good one to ask. Let's see. 5 years. This is since 2022. I mean, I guess it all depends. Here's a good opportunity. Let me bring this up to understand cyclical nature of stocks, right? This is 2023. Here's 2014. Here's 2008. And we have yet to get back to where we were in the 2015, 2016 timeframe. So you're right now trading at 2009 levels, 2005 levels. So again, I ask, I'm not saying don't do it, right? But I think what you need to look at is what is your goal here, right? What are you trying to do by investing in Schlumberger, So just some food for thought on that one. Do you have any opinion on oil companies Apache and EQT? I don't know much about EQT. I know they bought some folks that I went to school with, companies, and the Rice brothers are pretty dang good at what they're doing with respect to execution. Apache, the thing I'm looking forward to at Apache is understanding more about their Suriname assets and how big, and it seems like they're on pace to FID that in the second half of 2024 with Total. I'm curious if they're going to drill any more appraisals. I'm curious if they're going to do any more associated with it. So that's something I'm kind of keeping an eye on with respect to that. Let's see. Thoughts on Crocs, consistently low valuation justified? I don't know on Crocs. I have a buddy who swears by it. He's bought it. He's doing really well with it. Unfortunately, I don't have the DD on it. Let's see. June's talking about personal stuff. I don't want to put her on blast. Let me help you franchise a barbecue place so I can bring to your hometown in Florida. Deal. Send me the details on Twitter. On the Barry bonds of investing, I guess that means by me saying, I take my time. You don't have to invest in everyone. Nextera seems like a stock you'd like, Matt. Well, believe it or not, I have 500 shares of Nextera along with Orsted. So I'm up a little bit on that position of my personal portfolio. Nextera is a good one. Commercial renewable energy. It's the number one utility company in the United States, number one renewable company at the moment in the world. And them and Orsted are kind of neck and neck. Orsted's more so focused on offshore wind, though. Nextera is wind and solar. So I think the reason why Nextera has been slapped in the face, and I'll do a quick one on this one. The reason why Nextera has been slapped in the face is because, and shout out to the 102 people in here. If you're still here, please be sure to check out the link in the description and what I just posted, which is Cashflow Chronicles TV. Be sure to subscribe to the new channel. It's where Chris and I will eventually be rolling over to. So much appreciated with that. But the thing with Nextera is they've done a big capital investment program that they've ballooned up the balance sheet. And up until 2025, 2026, a lot of those projects aren't going to come online. Some of them are coming online through time. There's going to be a big tranche of projects that come online 2025, 2026. So yeah, I'm curious to see how they de-lever the balance sheet after that when all those projects start churning off a lot of cash flow. Folks get greedy with 100K and just invest it and live off the 5K per year. Like you said, my man, it can be greed. It can be greed. It's business, real estate, stock market. There are more money machines, for sure. Crypto too. Yeah. What stock would you buy if you win the Powerball? Let's just say hypothetically, if I won $1 billion Powerball and I was able to walk away with 300 million after taxes and taking the lump sum, etc., I'd spend 100 million of it and probably invest the other 200 million. Majority of which would probably be in SPY. I probably would do some. I probably would try my best for a year or two to just do SPY. It would probably take me a while to spend 100 million, to be honest with you. I'd buy some nice homes. I wouldn't buy too many, but I'd buy some nice homes and furnish them. And I'd probably put the majority of it in SPY. So even at 200 million in SPY, will generate you, what is that, 3 to 3.5 million in dividend income per annum. And so maybe I'd put all of it in SPY, but there might be a little bit of like a dividend income ETF or something like that. Or maybe I would figure out a way to write cash secured puts on some of it to generate a little bit of extra income. But I mean, after spending that $100 million is going to take me a while to spend. I don't really want for much. It would be nice to have a nice forever home. Where I'm living right now is not a forever home, but I'd probably buy some acreage away from the cities back in Pennsylvania. I'd probably move back to Pennsylvania. Yeah, I'd have to think it through, but I'd say initially it would probably be the SPY, and I'd probably take whatever percentage I needed. And if I really needed more than $3 to $4 million a year, I would just sell portions of the SPY over time, personally. Dividend paying stocks for Zocold. How long am I planning on to hold SLG? What would have to happen for you to exit? I plan on exiting my first tranche probably at the $50 range. For now, it's kind of a small position. It's 300 some shares, 350 shares. So that's what, like 12, 14 grand. It's not a lot. So for now, I think it's okay. I'll probably just keep writing the covered calls. And I'm sure I'm going to get caught with my hand in the cookie jar, as TJ would like to say, and some of them will get called away. So I'm up 100% though. So can't complain. I mean, it would be nice to be able to sell a portion at 50 and keep a portion and collect the dividend income. But it could also get to the point where I'm like, probably just put the majority of it in the S&P. Opinion on KMI for stability. I haven't done research on KMI in quite some time, so I'd have to do a little bit more work. George, thank you for becoming a member, my guy. Much appreciated. All that money goes back into the investment portfolio, the public investment portfolio that we talked about. And so much appreciated with respect to that. And I think you were already part of the Money Gang, if I remember. So welcome back if you were. I'm like 85%, 90% sure that you're already part of the Money Gang. So very excited that you are back. And like I said, all that money goes back to the Money Gang. So if you guys are interested, there's a little $ to the lower right of the chat box if you're on a desktop computer. And like I noted, that all goes back to the investment portfolio. And eventually we'll be moving over to the Cashflow Chronicles. So I can understand if you want to wait and spread that love between me and Chris rather than just me. I get it. Don't feel bad. But hopefully you guys continue, and we would love to grow that membership. Depending on what we end up doing, I hope we do 5 days a week, but we'll also potentially do private members chats as well. Chris has access to a Discord, so maybe I could work with him to say, hey, if people are subscribed to the Cashflow Chronicles, they could have access to the Discord. Because right now, you have to be part of Chris's Patreon to be part of the Discord. So keep that in mind as well if you guys are interested. Chris's Patreon is, of course, in the description below. Do you think a company that is retracing for possible acquisition news, not the target, will experience a delayed rally, or has that come and gone? I think that's very dependent upon the company. Um, let's just say, do you think a company is retracing from a possible acquisition news, not the target, will experience a delayed rally, or is that come and gone? Depends on the terms. Some companies might have a $3 billion termination fee written into it, $1 billion, $500,000, or $500 million. It really depends. And I think it all also depends on what the capital obligation is. Is it defocusing the I guess primary company? Very much dependent, right? And I anticipate you're probably talking about what was the company that Adobe maybe is what you're talking about. I think it all just really depends on what company it is that they were acquiring, right? I think that there would have been probably some backlash if Microsoft didn't get the Activision deal, right? So um, very much dependent upon what company it is. I don't think that whatever company Adobe was investing in was really going to move the dial too much for them, but I could be wrong. I don't really know. And so I'm just going to say, I don't know. And it's okay to say, I don't know. Getting down to the bottom, Bill White, thank you for the $1.99, my guy. Much appreciated. Cashflow Chronicles ETF contribution. I will love to see and give you guys the opportunity to invest in the ETF eventually. I have to talk to TJ. TJ, it reminds me, whenever you have some time, my guy, if you have like 20, 30 minutes, I'd like to talk to you a little bit about how you set up what you're doing today. Because I'd love to figure out a way that I can help people in any way, shape, or form. But I know that comes with obligations, right? Like we were talking about it the other night about having to create returns and stuff like that. It's like for me, my ETF is going to be rather simple. It's mostly going to be the S&P, but I'm also going to figure out 4 or 5 companies I think I can do outsized returns on. Versus Chris, he's going to look at things very differently. For his ETF, personally, it might be more actively managed, and he might do something that's less actively managed as well. But anyway, any stocks to look to leading indicators for recession? There's always there's this sectors by business cycle, sector returns by business cycle phase. Is this the one? This one's a pretty good. Using a business cycle. This is actually something I learned from reading Get Rich Carefully or Real Money by Jim Cramer. I forget what book it was, but I read it by him and it did a good job of explaining this. But generally speaking, when real estate starts to look pretty crappy, it's kind of when you're on the tail. But same thing with information technology, industrials, consumer discretionary. So all these things really took a hit in 2022, and things that gained, energy, consumer staples, materials. So like 2022, everyone was like very, very much looking into these sorts of things. And then once 2023 hit, you started seeing certain sectors get really impacted, like utilities, energy is taking a downtrend, and what has done really well, IT, industrials, materials, real estate's kind of starting to get back into swing with the interest rates. Financials have been doing okay. So it's like, to me, I think we're on the precipice of kind of an early to mid cycle personally. And so I think you have an opportunity right now to kind of position yourself, position some of the money that you're potentially getting into for this mid cycle, early to mid cycle. And so I don't think we're really in this late cycle recessionary, but if you're looking at it, information technology is going to take a big hit. It did in 2022. Real estate's going to take a big hit. It did in late 22, early 2023. So to me, that is where you're really kind of looking. And then things like materials and healthcare and energy are really going to prosper. And those things did prosper in 2022. Like if we just look at Exxon, for example, it really prospered. Um, coming in over the past 5 years. Let me share my screen again. If you look at like Exxon, for example, it really prospered into this cycle where late 2022, the recession was kind of at its peak and it's kind of been flatlined since it got to that point. And now it's getting flatline, flatline, flatline. And now obviously oil prices are being impacted a little bit. So it's retraced, 15% or so from its all-time highs. But will it persist there? That leaves to be done. But I think that and utilities, I think, is a good indicator of where you're at in the cycle. So kind of keep that in mind. So you would invest the money where you'd spend to a true investors, buy and live off the divvies, would trade zero DTEs for the lottery. Bring the family out to Texas, no more snow shoveling. Hey man, I can't force them to move. They're happy. That's what's all that matters. Um, they want to move to Texas. When would you exit Bros? What market cap or what year? This one's going to be one of those ones where you really have to see if the thesis is playing out. I could see the market cap getting to 20 billion, which is like a 4x from here. But my check-in would be at the end of next year where I'd really like to understand. It's like I don't plan on exiting the company, but it all really depends on what's going on in the company. Are they continuing to trend more towards cash flow break even? They are profitable, so you don't have to worry about that, but they are outspending in terms of capital expenditures more than they bring in terms of net income. So that means they are having to go to the markets to get more and more debt, which is part of the reason why they did the $300 million share offering, which brought the stock price down to the $24 range over the past 6 months and is now retraced in a positive sense since then. So you kind of have to keep that in mind. But yeah, that's one thing that I'd probably look at with respect to that. So I think late 24 is when I'd check in with this one. I would say if the thesis plays out, I don't think it's a sell before 2030. I think that there's going to be still room to run. But I think it all depends on what the stock price is. If the stock price warrants a $20 billion market cap, I'd probably take a portion, if not all my money, and run. Just because, while Bros is a good opportunity, if it pays some sort of dividend or something like that, I might stay around, or there's a lot of share buybacks or something like that, I might stay around. But they have a lot of capex, and they're less than 25% of the way to their 4,000 store goal. So it all just really depends. I just see a long time length between the market cap they are at today to where they're going to get to in terms of a $20 billion market cap. And I think, it's going to be hard for them to get to a $100 billion market cap. That's where Starbucks is, or like 100, 110. So do I think they can become the quarter of the size? Yes. I also think that once we expand to the East Coast for Bros, it's going to be an opportunity to start expanding to Mexico and also into Canada. And those are smaller markets. Specifically, Canada's a smaller market, but Mexico's a big open market as well. So I think it all just depends on, what happens in those markets. So we'll see. There's a lot of room for potential still there, and the East Coast is still wide open, literally, for Bros. So I think it's just way too early for this one. But earliest check in for a potential sale would be late next year. But I think that would be too early, and I think things will trend in the positive. I didn't mean to mute. I meant to switch to the next. Any thoughts on NEP? Those master limited partnerships are tough. I know they just said they're going to stop going and trending so much um, for what's the word I'm looking for capital investment. But that's the thing with these NEPs, you have to worry about the balancing of share dilution. I think short term it'll see some positive gains just based on the fact that interest rates are going to go down. It's a very interest rate intensive business, but at the same time, I'd rather be invested in an Nextera Energy than the Nextera Energy Partners personally. Not to be crass, but I heard gentlemen's clubs are the best indicators of recession. Get out there and do research. That's a funny one. I like that. I'll go this weekend for DD purposes only. True investor. Yeah. It's actually ALK 52 week high, 57. Market didn't like Hawaiian Airlines acquisition. Target dropped it from 39, got it at 33.6. Missed estimates, but still profitable back up to 39. Okay. A message from Twitch. Do you think it's possible to start day trading with $100? Where would you be best starting point? I think you need to recognize whether or not you have the time to dedicate day trading. Do you have 3 to 4 hours a day? If the answer is no, and 3 to 4 hours a day uninterrupted as well, not like, oh, I can trade for an hour this part of the day, and I can trade for an hour in the middle during lunch. I can trade an hour towards the end. It's like, no, do you have a straight set of time to dedicate for 3 to 4 hours in the morning, or like a certain window uninterrupted? And if the answer is no, probably tough. I think a lot of people think that they could start off day trading and then they have to get called into the 10 a.m. meeting at work and they're like, oh shit, but this is dropping by 50%, immediately. And I need to sell it. And it's just like, what do? Do you like tell your boss to F off, or do you sit at your desk and get in trouble for not coming to the 10 a.m. meeting? So I think very quickly people recognize. So I think it's possible. Yes, but I would say most people will fail and fail very, very fast. I think that the easiest way to double your money, if you're starting with $100, is to add another $100 to the portfolio. And what I will probably say final, unless there's one or two last questions that kind of trickle through, because we're losing people here, probably because it's late and I'm droning on too much. But if, let's just say your goal is to become a millionaire and you want to go, let's say it's not $100, but it's $1,000. In order to get to $1 million, you need 1,000 extra money, right? So not 1,000%, 1,000x, right? So it's a $10,000, $100,000 sort of return. If that's the case, what's the easiest way to go from $1,000 to $2,000? And that's to add another $1,000 to the portfolio, right? You could try anything in the world. It's going to be very difficult for you to be able to come up in your mind to double your money very quickly. It's more easy to find a way to cut expenses and little things that you don't necessarily need and add that to the portfolio on a very consistent basis than it is for you to figure out magically a way to get 100% return on a stock and do that 1,000 times. So I think the problem is everyone thinks they can day trade their way starting with $100 or $1,000 and become a millionaire, when in reality, you need to think about being a millionaire and what a millionaire would do before you're actually a millionaire. And a thing that I like to say, and it's the truth, is before you're a millionaire, there's exceptions to this, like luck, inheritance, etc. But if you're going to work your way to being a millionaire, you better think like a millionaire, and you better mentally be prepared to be a millionaire. Because if somebody gives you $1 million and you don't know how to handle $1 million, it's going to go poof. You're going to buy a Lambo, that's 400 grand, and you're going to go buy like a shit house for 600 grand. And next thing you know, you're like, I'm back at zero again. And it's like, well, you didn't budget appropriately. You didn't think about this. You didn't think it through. You're not thinking like a millionaire. So boom, you're not going to be able to keep the $1 million. And Jim Rome, who is a famous consultant that was actually a mentor to Tony Robbins. So folks that know consultants and personal life coaches and stuff like that, like Tony Robbins, the coach to Tony Robbins, one of the key things that he said was, if somebody hands you $1 million, best you become a millionaire quickly so you get to keep the money. Otherwise, it'll surely disappear. So I'll say it again. If somebody hands you $1 million, best you become a millionaire quickly so you get to keep the money. Millionaire in your mind. So you get to keep the money. Otherwise, and I'll spell it out, if you're not a millionaire in the mind, the money will surely disappear. And that's what happens with lottery winners. That's what happens with NBA players. What happens to these people that have all this opportunity come to them where they have gotten this excise wealth in a very short amount of time, where they haven't been able to put the right steps or systems in place to truly get themselves up to the internet. And I can say this from experience, right? You have to put the steps and work and effort into being a millionaire up here before the numbers show up. And I say that with experience. It might not look like it, but I promise you. And that's the truth, because if somebody just magically hands you $1 million, or you see these crypto millionaires, and next thing you know, that's like, well, they had $5 million, and now it's back down to 500 grand or to nothing. And it's like, well, there's a good story I actually told to Crossroads today about somebody who, and it's like, this is even on smaller scales. It doesn't have to be on the millionaire scale. They got lucky. They invested in Dogecoin when it started mooning. They turned $5,000 or $10,000 into $70,000. And this was back when TikTok started to become a thing. And so somebody reached out to me, and I actually chatted with them on the phone. I said, hey, I was like, what's your objectives, right? Like, what's the goal here? Because they wanted to hold it to as $150,000. And I said, you turn $10,000 into 70. Like, that's great. Like, take your money and run. Like, who knows what's going to happen? Maybe it goes to 150. And maybe, you end up being like, ugh. But I was like, how would you feel if it goes back down to 15 or 20 and you didn't cash out anything? I said, what are your goals? It's not my decision. It's their decision. What are your goals? It's like, well, we want to be crypto millionaires. So it's like, well, then, I'm going to shut up. Right. Like, but they said, we really want to own rental real estate. And that's our goal. We eventually see ourselves as being real estate investors, and we would really love to get. I was just like, what do you think is more important to you right now? Do you think that having this $70,000 and the potential of getting to 150? I was like, what happens if you get to 150? Are you going to stop there? And they sat there and they're like, I don't know. And I was just like, what would happen, and how would you feel if by tomorrow, because this is a reality that could happen, and you open up your portfolio and it says 50? What are you going to do? What are you going to do? And they're going to be like, I don't know. Like, and they started like floundering. And I'm like, how would you feel if you were able to take out the $70,000, this gain of say 60 or whatever it was like 60 or 65 grand, and buy rental properties with it? Buy two. Where do you live? What can you buy? And they were like, well, we live in, Tennessee, and houses in our area are $200,000. I'm like, it's like, you could buy almost two properties with that. Right. And so, 70 grand. It's like, you could buy one at 10%, buy the other at 15%, like figure out a way. But you could buy two properties at $200,000 a piece and make them rental properties. And this is when rates were favorable, right? So we're not talking 7-8% interest rates. We're talking, low threes, low fours, or high threes, low fours interest rates. I was like, you could start your rental portfolio today off of a mere $5,000 or $10,000 investment. You now have 2 rental properties. The thing and goal that you wanted to do is now in your hands. It's tangible. What's more important? And then I didn't hear from him. 3 months later, I got a call or a text or whatever. I think it was like a text on TikTok or something like that because you can write comments or whatever. It said, thank you. Because we sold. We didn't sell at 70, but we sold at 55. We woke up like a day or two later, it was 55. We sold. We ended up buying our first rental property. And I said, what's going to be more important, right? Because what happened to Dogecoin after that, right? It didn't stop. Their portfolio wouldn't have stopped at 55. They captured 55 or whatever it was, and they bought their first rental property. And that wasn't my decision, right? That was me laying out the options and opportunities like you have to do in your head. And they got their first rental property. And that was their dream. That was something that they wanted. They discussed it as a husband and wife, that they wanted that. And so sometimes we get so lost in the numbers that we lose sight of what's actually important. What's your objective? What's your time horizon? What's your risk tolerance? How much money are you going to add? How active or passive do you want to be? I also, to this gentleman who's asking me on Twitch, I also thought I was going to be a day trader and trade myself up to $10 million and be retired by today. I also thought that. And then I had to get called into the 10 a.m. meeting, which is 11 a.m. Eastern time. And I think it was like Regeneron Pharmaceuticals or something like that, which was trading at 48 cents or something like that back in the day. Ticker symbol was RNN. I've looked at it since. I don't know if it's defunct or what happened to it. But boom, I come back, 10% gone. Can't day trade when you got to go to the 11 a.m. meeting or the 10 a.m. call, 10 a.m. meeting. So you really have to think, man, like you have to see if your priorities truly are there. It's like, it's real easy to see somebody talk about selling a course about day trading for $500 and be like, yeah, I need to follow this guy. It's like the guy's making his money off of selling the damn course, not from actually day trading. He could break even and just be like, oh, today was a good day. And like only show that. We didn't show the day it was down 20%. And he's making $500 off of your purchase of the course. Trust me, I've seen these scam artists. I've interacted with them on YouTube, right? Like it's sad. I could easily sit here and try to sell you some sort of course or be like, yeah, man, pay me $25. We'll talk about it through Discord or something like that. And it's like, but I'm not. I couldn't look myself in the face and do that. So that's what I do here is for free. But anyway, so I'm losing people. Hopefully that was helpful. You probably already signed off because I didn't give you the answer quick enough. And I don't see any responses. But let me see. Let's see. One last thing or two. What amount does the needle start to move? That really is dependent upon you. Some people probably in my shoes would have either retired, moved to Thailand, which I almost did in 2021 myself, or just kept dividend investing. I think Google will offer dividend in a few years. Yes. Did I answer these already? Maybe you left and just came back. I think in like 10 years, they might. 5-10 years. I just don't foresee it with the next 5 years. Let's just see. You got to build the nets before you lay the eggs. I like that one. Plan is to be Who Wants to Be a Millionaire? Answer every question. Currently still waiting for an email back. You'll get there, my guy. Persistence is key. Call for the night, but great stream as usual. Thank you, John. Much appreciated. Always like seeing you on the stream. Hope to see you again soon. Never knew I do listen to Jim Room. That's awesome. Jim Room's great. Those 12 songs are over. Still pushing your 2018 Toyota Sienna Lambo, not even in your head. Hey man, I can't even fit in a Lamborghini, you know? My name is Matt Money. Those 12 songs are actually 120 songs. Let's see. Junebug. Keeping it real, changing lives. Nah, man. I mean, I was wanting to hear. I was thinking if I was in their shoes and that's all the money I had, they didn't have any other investments. That was like their only investments they had. Um, I think they said they had like $10,000 or $15,000 in other like 401ks, stuff like that. And so I was just like, dude, like if that's your dream, real estate's your dream, like you have a bird in the hand, take it, you know? You're 22. What's your advice? Uh, you have time on your side, and everyone's going to tell you that, and you're going to ignore it. Don't ignore that. You have two paths. You can, um, be very honest with yourself, right? Look at those 5 things I just talked about: objective, time horizon, risk tolerance, how active or passive you want to be, how much money you're going to add, and be brutally honest with yourself. Truly, brutally honest. And if you're brutally honest with yourself and you recognize that I can add $200 a month and I don't want to focus on this very often, I just want to let it set and forget it. Robinhood investing, M1 Finance investing, or your 401k or Fidelity, and my employer is matching 7% or 6% or 4% or whatever. I promise you, after adding $200 a month over the course of your life, and if not, hopefully stepping it up over time, you will be a millionaire. Will $1 million be what it is today? No. Right? But for example, if you were to appropriately invest in an S&P 500 and it has returns that are historic, like 8% returns or something like that, you will turn $1 into $32. After inflation, it might be $16 to $20 of today's value, but you have now turned $1 of today's value into 16 to 20 of future value, or today's value in the future, rather. It might show up as 32 times, so it might show up as $32, but the spending power will be between 16 and $20 over the course of 30 years. So you have some opportunity to take on some extra excise return. You also have time to put some elbow grease into things. One thing that I recognize, it's much easier to do side hustles and add to your portfolio and put it into a guaranteed index investment than to try to do the latter, which is like take whatever money you can save and try to like hustle your way and day trade your way to increase in the money. Avoid lifestyle inflation. That's something I struggle with, even though I'm very conscious about it. Like I used to have a $500 car payment. Now I have a $700 car payment. Maybe it's $720, $713. Some people, it's a lot of money. $713 is a shit ton of money. I still hear you. But at the end of the day, it's not that much for me. So, but it has crept $500 to $713. That's creep. So that could be $200 extra I put into the market every month. But lifestyle inflation has kicked in, and instead of driving a 2009 Chevy Avalanche, I wanted to buy it when I moved back from Trinidad, a 2018 Tahoe. So I have my 2018 Tahoe. That's probably it, man. I mean, like to me, most 20-year-olds, they would do best by investing in the SPY, investing in a good returning ETF, and just do it monthly as much as they can reasonably afford till they're not broke. Have some spending money, enjoy your 20s, enjoy college if you have that opportunity. You don't have to go to college. If you do go to college or you're in college, choose a major that's actually going to pay you a damn instead of getting 50 to 100 grand in debt and not have a major that's worthwhile. STEM is very good. Engineering, finance degrees are good. Avoid things that are more like liberal arts degrees. Not to say that those are bad, but you could always be a plumber. You could always be an electrician. You could always be a contractor. Those pay well as well. You don't need to go to college. You might have to get certifications, but you don't need to go to college. All that sort of stuff. Two more. Nah, I'm done. I'm done. 20K portfolio you're investing with. Keep it up, man. Keep it up. And one of the other things that somebody, June said this, but I agree, is like listen to a lot of people's opinions and perspectives. Think internally about what's right for you, and then act. Don't necessarily say like, oh, I need X, Y, and Z because this is what like I could tell you to buy Skechers tomorrow and it could go to zero, right? Like, who's this random guy? You know, like Skechers, interesting. Do your own due diligence and be like, or you could just be like, I don't have time, and you could be like, you know what, I like 500 profitable companies, S&P 500, boom, and you're like, I'm going to spend my weekend hanging out with friends and playing football or going to the beach or whatever you see best, right? If you had 20K, where would you invest it for the long-term growth? Very, very important question is like, is this your only 20,000? Say I have say I have $1 million portfolio and I just happen to come across 20 grand and all that $1 million portfolio is already invested in the S&P 500, then I'd put it all into TQQQ. But if I didn't have a very steady S&P 500 portfolio, and this is the only $20,000 I'd have, I most likely would just tell the person, put it in the S&P 500. Unless they honestly have the time to. Let me just say this. If you're only watching me and Finance Junkies and Chris Patel on Cashflow Chronicles, you're not doing enough due diligence to invest in individual securities. Even if you're just putting those 2 hours in a day and you're just listening to us, because it's like there's so much additional, like we skim over all of our due diligence, right? Like, so you have to think like, are you actually going to know everything about Enphase just by listening to 20, 30 minutes every couple days from Vitaly and Carlos? Maybe you think, but there might be other things that you might not necessarily agree. New camera. Why do I feel like this is replaying stuff? Yes, new camera. I bought it 4K camera. You still always go to drop to the 70s. It is in the 70s. Oil is in the 70s. Austin, thank you for the money, gang. Thank you so much, Matt, for your dedication. Best content on YouTube finance. I appreciate that. I do it for you guys. Always love your investment, psychology, and philosophy. I do it for you guys, man. I do it for you. Thank you. I appreciate you guys always stopping by. Not gonna lie, TJ gives the buy course vibes, and I hold no, TJ doesn't do that to me. No, TJ is a great guy. I think he's just in a different avenue, right? Like I'm investing for myself. I'm an individual guy. He's investing for other people, right? Roth IRA, they say. I think so too. Liberal arts degree, they are bad. Don't sugarcoat it. You know, I can't say that it's good or bad. It's just I would love to be able to have so much money that my children could do liberal arts degrees. I strive for that. They can have as much fun as they want in college, or if they want to go to college and not pursue a trade, and them not have to worry about it because they have the opportunity to fail and be able to pick themselves up by the bootstraps, and they have, you know, funds from my work, and they also know how to manage it so they can focus on art or something of the like, right? But it takes a lot of hard work to build capital, and so that capital has to come from somewhere. And if they're just using it and they're not adding to it, then the capital will soon disappear, for sure. Don't jump in and out of stocks. Just add more and buy good, profitable companies. The risky picks are speculative. The more conviction, the more you can invest when you're not emotional about investing. That's the thing. People can get convicted, but they might not necessarily be convicted rightly. That's part of the problem. But I agree with the majority of that. Hopefully this will be a transcript, make a summary of it for sure. We'll see. June, you're always the best, man. Would love to meet up again in the future. You're always the best. Didn't realize it dropped as I'm watching Exxon and Chevron. Oh, okay. Very good. The lightning seems to be better. Oh, the lighting. Yeah, I got a light as well. Yeah, Chris and I talked. Like I used to have a ring light. That ring light turned out to be a piece of crap. Back in the old apartment with the good view, the green screen, as people used to call it, which I did not have enough people over at that apartment. I really didn't. In retrospect, that apartment was dope. Anyway, I had enough people over at that point. You know what I mean? Anyway, so uh yeah, that apartment was something else, man. But anyway, I have a house now. I'm a grown ass man. I have man things. But yeah, so Chris and I talked. So we got the light, we got the new cam, and it's long overdue, right? I've been doing YouTube for God knows how long. But the majority of my YouTube content for the first several years was strictly me screen sharing and walking through my portfolio. And then when I hit a certain value in the portfolio, I stopped really sharing the screenshots, which is kind of why it's nice to be able to do the public portfolio because I don't want everyone like becomes a security hazard, right? Like everyone already knows my name, like so it becomes a security hazard at that point. So I kind of have to protect myself, right? And there's already been slip ups where it's like, well, I have to close that account, right? Like, because account numbers get leaked and stuff. And I don't know, security efforts. So there's certifications and password changes and stuff like that people have to go through, and certifications of like two-factor authentication. But it's like anybody really could go after it if they really wanted. And unfortunately, I kind of put myself out there, so it's like I stopped sharing a lot of that stuff. I'll talk about it, but yeah, knowing where it is and what portfolio, and that's all kind of you know stuff that is for me to know. And um the public portfolio will make public, and other than that, we try to keep it on the DL. Once I woke up one day and I was like, I made it. The dollar figure was the dollar figure, and I was like, I made it. And I was like, you know what? I was like, to me, it's more about the message than the number that I'm sharing on the screen. Because you could go back to the portfolio videos. There's however many videos. You could be like, they're big numbers, right? Especially for like 29, 30, 31-year-old old me. And you're like, that's a big number. And then, once you hit the number, it's like, I don't need to share it anymore. Like, I proved to myself and myself only what's more important is the message. And just because I have a bigger number next to it, does that really mean that the message is more or less true? It might have more experience behind it, but just because I hit a certain number doesn't mean it's more true. So, it might come from a better perspective, but it doesn't mean it's more or less true. So just keep some thoughts about that. All right, guys, you guys rock. You built a stage and we're out to the living room now. What street did I grow up on? What's my favorite type of pizza? All those sorts of things, right? I always love that when people are like, I forget who it was, like a couple, like 6 months ago or something like that. They started asking me these questions, and I'm like, do you want my social security number too? Like, what's your address right now? Like all these things. And I just thought it was super funny because I was just like, why do I feel like I'm getting interrogated by the police? Like what is going on? And some people just have that vibe about them. It's pretty funny. And most of the time they don't mean to. It's just like they're very actually genuinely curious. And sometimes people are very much like, if you don't ask questions, you don't know, you don't find out. But hopefully this video, guys, had some good insights. I didn't mean to do another 2.5 hour stream, but it just goes to show you, I would love to do this more for you guys and be full time. But unfortunately, I do have to work. And unfortunately, I was hoping to take the whole week off. I will either have to do some work tomorrow or on Thursday or Friday, just because this is how the way it is. So I'll have to figure out another day or two that I can take off in January instead. But I hope this video finds you guys well. I'm going to go run downstairs and grab something brisk to eat, and then head to bed after I watch some TV. My sleep schedule's all messed up because of that 6-hour stream, and I am exacerbating it by staying up till like 2, 3 a.m. But as always, you guys have been great. 80 of you guys stayed. Please do me one last favor. If you haven't already, subscribe to the Cashflow Chronicles channel. It would mean a lot to me and Hot Chris. We will eventually be moving over to there. And let's just see what we're up to in terms of total members. We're up to 281 subscribers over there. So it would really mean a lot to me, guys, if we were able to get it to 300 over the next few days. Much appreciated. And we'll talk to you guys soon. We have tomorrow Steven Fiorello talking about energy transfer, and we'll probably talk a little bit about LNG as well, because they kind of go hand in hand with each other. And Thursday, we don't really have a topic, but as always, more and more information comes out every single day. So we'll have more details. Will Google hold up? Will Amazon hold up? Will all these stocks go down by 5 to 10% in the short term? We will see. But until then, till next time, you guys rock.